Good morning. It is Monday, August 15th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brian Sozzi and Brad Smith. Let's check out the futures here this morning. I almost combined their names this morning. Let's take a look at futures where we're indicating a lower open, down 2/3 of 1%, off by 221 points for the Dow. We've got S&P futures down by about 0.7 of 1%. Nasdaq 100 futures lower by about 0.5%. And looking cross-asset here for just a moment, really the most notable move this morning is happening in crude oil, where we're seeing a drop of about 5%. That has to do with some Chinese economic data that we're going to speak about in just one moment, and the possibility that we could see a production increase from Saudi Arabia. All of that pushing oil prices lower below $88 a barrel. Saz?
Don't worry, Julie. Brian Smith and Brad Sozzi have you covered. Here are three things you need to know right now. COVID lockdowns and a deflating property bubble caused a rough July for China's economy, missing estimates for retail sales and industrial production, among a long list of others. This all leading to two key interest rates being cut by China's central bank. Both the one-year lending facility rate and the 7-day lending rate were cut by 10 basis points by the People's Bank of China. The bank is also putting over $59 billion into the financial system to help wider economic growth. In the mood here on the street, at least in the early going, perhaps China is not doing enough here, given the slowdown it is seeing in the economy. We're seeing some weakness here in the futures.
Well, the big thing, too, is that since 2015, they haven't missed one of their official growth targets, and they're on track to actually do that. And that comes after, of course, they're continuing to enact their zero COVID policy, or the zero tolerance policy around COVID, and that's prompted lockdowns. But I think over this extended period of time, even with what we're looking at right now, which they had set their target at 5.5%, they're set to miss that. They've also got employment situation that continues to remain up in the air right now. It seems like the jobless rate has eased to about 5.4%, but still at this point in time, there are more question marks, and that's without even getting into the real estate conversation in China as well right now.
Yeah, so I just want to dig into some of the individual numbers a little bit. We're showing the unemployment rate, which actually improved in July, but didn't improve if you look at the youth unemployment rate specifically, ages 16 to 24. That was a 19.9% unemployment rate. The country only started coming out with that specific data set in 2018, but it's the highest since they started keeping track of that. So that's something that is potentially worrying. Retail sales, which we alluded to, 2.7% increase. That is a slowdown from 3.1% in June, and it's lower than economists anticipated. So basically, we got just this list of different economic data points, and all of them pretty much came out below estimates. Part of it certainly has to do with COVID shutdowns here, but you also have to wonder if there are some underlying concerns, especially if you think about the read-through from some of the inventory buildups that we are hearing about here in the United States. One would think that would have to then have a ripple effect.
Yeah, Citi coming out with a flash note on this. Their team saying more growth supporting efforts are needed beyond monetary policy. So the street, I think, was just looking for more here, just given the weakness economically in China. They didn't necessarily get it. The next thing I'd be watching is some of these earnings results out of some of these luxury companies that do business in China. Starbucks, of course, didn't have a great quarter in China because of the lockdowns a couple weeks ago. But I'm talking about a Tapestry, a Capri. I think Louis Vuitton caught some weakness after this report. How are these companies doing? That could be another shoe to drop.
But it begs the question of whether we're seeing a similar type of luxury buyer in China as we are here in the U.S., because luxury or the upper income buyers in the U.S., clearly they're still spending. So it's just a matter of at what frequency or what cadence relative to when times were a little bit more rosy, when everyone was perhaps here in the U.S., really looking at the additional amount of money that they were having, either as a result of changing jobs and the opportunity to do so and get a higher wage, or because of a short-lived or a stimulus that they could essentially lean on if they wanted to. But that far removed at this point in time, a year and change removed. Now you think about China as well, and if they have a similar profile of that consumer, that could perhaps still be spending on the upper side.
What's Tesla doing? I mean, Tesla's had a lot of momentum in China, but is this news bad or good? Because you're cutting rates, maybe that spurs more car sales, but have their sales fallen off a cliff?
The car numbers were one of the better points within all of these data points. The car production numbers were actually better than expected. By the way, it's not just about Tesla or Tapestry. It's also about the Chinese-based companies that trade here in the U.S. that we can track, like an Alibaba, for example. You see theirs trading lower this morning. You've got the Chinese automakers trading lower, although Li Auto also came out with disappointing earnings, which we're going to talk about later. But JD is down. So it's also these big, especially consumer-facing companies in China that are seeing some weakness as well.
Yeah, absolutely. Let's also talk about a Goldman note that's been out over the weekend. Goldman Sachs, ahead of this week's Fed minutes, highlighting the Fed's pivot and questions whether a large shift in the Fed policy rate profile will be enough to support a reliable bottoming in risk assets. There you're taking a look at the target rate. This would be the target rate post this upcoming meeting, and particularly here for what Goldman Sachs is noting, and largely the questions that many of us have had, is the economic data that we've seen come through over the past week on the CPI data front as well as on producer price index. Is that enough to have them soften their outlook, or does that just mean some of the steps policy-wise that they've taken thus far are finally fully being ingested, or at least starting to be ingested as well by the economy?
Yeah, I mean, let's drop a real-time Yahoo you here, because I think investors are going to hear a lot of what is called a dovish pivot. Now, if you were not an investor, you would have no idea what this even means. Essentially what it means is the Federal Reserve might become a little more friendlier on the path of their rate hikes in coming months. Now, that's basically what this boils down to. But I like what Goldman said in this note here, and that is Vicky Chang is the author of this report, that for the correction to really end in the markets, for markets to really rally, the market has to get a sense that the Fed is not just done raising rates, they have to start cutting rates, and there's no indication that's happening.
Traditionally, she said that's when the market turns. She's not clear that is what that we're gonna follow that playbook this time around. Another way to describe the pivot is when you go from tightening to easing, right? You go from raising rates to stopping or even cutting rates, right? And we are not there yet, even though the market is predicting we are going to get there. We haven't seen the actual signs of that happening, right? And when we talk about economic data, I just want to mention one relatively minor data point that came out this morning when we're looking at the big economic picture, and that's Empire Manufacturing. Manufacturing in the New York region really showing a weak reading here, a negative 31.3. The prior reading was 11.1. You flagged this for us this morning, Saz, and the survey was for a reading of 5, so negative 31.3. Now, as you pointed out, Brad, the other economic data we've gotten recently has been pretty darn good. Yeah. So this is one region, could be an outlier. Could it be a reflection of what we have been seeing in terms, again, going back to the inventory question? Maybe. It's just one data point, so we'll see, but it's not a great one.
It's also been interesting to hear just about the employment situation from the private sector versus what the Fed is reading into right now as well, and where particularly going forward from here in the upcoming jobs reports even that we get, even though the last one was strong and perhaps unexpectedly as strong as it was, where the Fed from here continues to lean into the employment situation side to say, okay, well, we still have a lot of room to go, or at least wiggle room to work with, even if the employment situation holds strong, even if some of the efforts that we've made thus far are starting to be priced in, not just to the markets or ingested by the economy separately as well.
Yeah, well, I keep talking about inventory this morning. So let's talk about the industry that has been most affecting. That's retail, of course. Looking ahead to a busy week, all the major retailers, or many of the major retailers, are set to report their numbers. We're going to have Walmart on Tuesday. I believe Home Depot's on Tuesday. Target and TJX coming to us on Wednesday. And obviously we will see some kind of confirmation or not, or maybe signs of improvement with some of these retailers. Now, on the plus side, gasoline prices have come way down, right? How many straight days do we have now with gasoline prices falling? I believe
maybe 54, 55.
Gas Buddy brought us the numbers this morning. 61st.
60. Well, okay. Wow, I'm off.
Day that gas prices, average gas prices, are down nationally again, according to Gas Buddy, $3.92 a gallon. I think I saw in the 350s this weekend in New Jersey.
I paid $5.09, but I got the premium stuff.
I
got the premium stuff. I'm not putting 87 in my hot rod. Yeah. No way. No way. But look, retail, we talked a little bit about this last week. Yeah. Inventory levels year over year, what does that look like for retailers? I think a lot of folks on the street are bracing for very bad margins and earnings misses from a Walmart, Target, maybe not Home Depot. They've been buying back a lot of their stock, but a Lowe's, and that was, I think, suggested by Weber this morning. Awful quarter from this company that sells into both Home Depot and Lowe's. But anyway, looking for a lot of weakness on margins, high inventory growth, and potentially weak outlooks for the third quarter. The savings grace here could be, how are these companies guiding for back-to-school sales? Now, you noted gas prices are down. Has that fed through into how back-to-school started? Not sure.
Yeah, and we're amidst that season right now. Some schools preparing or have already started to go back. And then you think about as well on the e-commerce side too. I think that's going to be critical to look at this earnings season. Inventory, no doubt, has been this story of the past 2 quarters for retail. But now you start to think about where consumer appetites are not even going to the websites to do searches. That could potentially show up in the e-commerce sales data. And that's where we typically get into some of the different website tracking tools that are out there. Amazon, for what it's worth, they had already seen traffic down over the course of this year coming into that last earnings results that came out earlier this quarter. And so with all of that considered, I think on the e-commerce side, if you're seeing similar with Amazon, what you're seeing in some of or seeing similar with other retailers, what we did see with Amazon, then that could potentially be one of those headwinds that they have to navigate through despite all of the major investments that a Walmart and a Target has made on the e-commerce side of
Something else important to mention as we go into this week of these earnings is how the stocks are setting up, because they've performed.
Target's been
well.
ripping higher, like 16%.
Yeah. So both Walmart and Target made their lows on June 17th. Mm-hmm. Interestingly, Walmart did not make another low for the year, even after it cut its forecast. It fell, of course, but it didn't make another new low. So Walmart is up 12% since that low. Target is up 24% since its low on June 17th. So if they do come out and disappoint again, do they cut further, et cetera, is that priced into these stocks when they've had that recovery?
They're getting hammered because that whole run, I think we talked about it, has really coincided with the plunging gas prices. So the street is hoping that consumers have taken these gas savings, went to Walmart, went to Target, and bought things. But that is wildly unclear. I track a lot of the week-over-week data, spending card data or credit card data from Citi and Bank of America. Sales have slowed. They have not picked up so far in back to school. So the outlooks could be pretty shocking. And probably one of the most weak sectors, and we're showing on that calendar, Kohl's. Some of these department stores, Kohl's, Nordstrom, you go to these stores right now, high levels of clearance, lots of inventory from the summer not sold. That is
because
bad.
People are still buying stuff, as we've talked about before. It's just what they're buying is different.
Yes, and so to that point, because I forgot my green pom-poms at home, but I did want to bring in DLTR, Dollar Tree, into the conversation too, because when we do see, typically, historically, when you see times of consumer confidence or consumer sentiment starting to wane, Dollar Tree is one of those names where they will continue to go back to, because you know everything in there is going to be $1.
I like Dollar Tree.
Yeah. Dollar Tree is up year to date. Over the past year, it's up 64%. Year to date, I think it's up 18%.
I get paper plates from there. Yeah, it's great.
I mean, well, better than Party City at that
absolutely.
point.
I have no problem with it.
Yeah. All right. Well, that's my Dollar Tree.
You didn't think I like Dollar Tree? You think I just live on the high end and go to Suit Supply and wait 3 weeks for a custom suit? Well, we won't go there.
I mean, you're putting premium gas in your vintage.
I go to Dollar Tree. I buy plates. Okay. Thanks.
They got good plates there. Good plastic ones too. Guys, coming up, we're going to speak with one analyst on why he says the EV space may experience accelerated demand following the Inflation Reduction Act. That is next. Welcome back to Yahoo Finance Live this morning, everyone. The Inflation Reduction Act is set to be signed into law by President Biden in the coming days, opening major opportunities for investors in the clean energy space. For more insights on this, we have here with us today Jay Jacobs, BlackRock U.S. Head of Thematic and Active Equity ETFs. Jay, always a pleasure to speak with you and get some of your insights. First and foremost here, when we think about valuations and what people should realistically price in and anticipate in terms of what the Inflation Reduction Act will mean for equity companies, what should we expect?
Well, we've seen a history of investors underappreciating or underestimating the impact of these disruptive themes. So if we rewind to 2017, Bloomberg's New Energy Finance forecasted that by 2021, there'd be about 2.9 million electric vehicles sold. The actual number in 2021 was 6.6 million. So we have a history of underestimating the power of these disruptive themes. Now that we have $370 billion coming from the Inflation Reduction Act, we expect that to continue to accelerate the growth of electric vehicles and really help companies along the value chain, from car manufacturers to battery manufacturers to lithium suppliers to parts, all involved in electric vehicles, to benefit from this bill.
Hey, Jay, it's Julie here. How much will they benefit? Because there are some, particularly the electric vehicle space, there are some rules around this, right? It's not just any electric vehicle that's going to be eligible for this. They have to be assembled in North America. They have to be under, 55,000 or 80,000 if they're trucks and SUVs. So it's not as though this is like willy-nilly for any electric vehicle. So do people have to be a little bit selective in terms of what they're looking at here?
Yeah, so this policy is really designed to achieve two things. One is, how do we build out an electric vehicle industry within the United States, from the manufacturing perspective to the upstream perspective of getting lithium and battery materials ready. And then the second aspect is, how do we make electric vehicles more affordable and turn them into mass market vehicles? Right now, the average selling price of an electric vehicle is about 22% higher than your average car sale in the United States. So clearly, it's more of a luxury item today. But the idea of providing these tax incentives of up to $7,500 for EVs manufactured in the United States is to turn them into the mass market vehicle. Don't have EVs compete with sports cars. Have them compete with everyday cars that are driven for hundreds of thousands of miles at very inexpensive prices. So I think that's really the shift that we're going to see with this bill being passed.
Well, Jay, I think the Tesla can easily beat a Lamborghini, and we've seen those videos on YouTube. But look, if you want to invest in this space, is there an easier way to do it than doing your homework, per se, on individual stocks?
Yeah, absolutely. I mean, at iShares, we're big advocates for ETF investing. We, of course, have an ETF, IDRV, investing in the entire value chain of electric and autonomous vehicles. So this is hard for investors to understand, the companies beyond the headline names. Who are the parts manufacturers? Who are the battery manufacturers? Who are technology companies innovating in autonomous vehicles? This is difficult research. And also, a lot of these companies aren't just in the United States. They can be in partner countries. They can be overseas in emerging markets, in Asia, in Europe. And being able to access all of those companies in one trade through the efficiency of an ETF, we think, is a huge benefit to investors.
Okay, so that's one of the beneficiary thematic plays that's out there. But who gets the goose egg here?
Well, I think it's really going to be felt across the entire value chain. I mean, this is the birth of a new industry. This is a revolution in transportation. It's not going to be one winner. We think that there's going to be many winners in this space, and it's going to expand beyond just passenger vehicles. We're going to get into trucks. We're going to get into alternative forms of transport. So as we see this theme continue to accelerate with this bill helping it, as well as falling prices, as well as greater consumer adoption, as well as greater infrastructure build out, we believe we're going to see a really rising tide for the entire electric vehicle industry.
And Jay, as you alluded to, I think at the beginning of the conversation, it's not just electric vehicles, of course, it's renewables more broadly. And in fact, we're going to talk to the CEO of Plug Power a little bit later in the show. So do you think that people should just kind of buy the whole green, quote unquote, or renewable industry right now?
Well, we think there's specific themes that are going to win. So, we've of course talked about electric vehicles, but clean energy we think is a beneficiary as well. We've seen a lot of interest in our iClean ETF, ICLN, which is looking at the entire global clean energy value chain as well, because a lot of the Inflation Reduction Act is also focused on providing production tax credits for companies to manufacture things like solar panels and wind turbines in the United States, as well as utilities companies to implement those technologies and produce electricity using solar and wind, as well as hydrogen and other forms of clean energy. So there are many facets to this bill, but EVs and clean energy, we think, are going to be kind of the two main winners based off of where the dollars are being allocated.
Jay Jacobs, BlackRock U.S. head of thematic and active equity ETFs. Good to see you as always. Have a great week. All right, Shiba Inu and Dogecoin catching some momentum as retail investors await Ethereum's software upgrade. As you can see, Shiba Inu seeing a pop in the last 24 hours and is up about 25% in the last 5 days. We'll continue to watch that one. We're also watching Dogecoin, not seeing as big of a spike, but up about 6% nonetheless. We're seeing some noteworthy moves here in both these names, despite crypto really being battered and bruised in the last few months. Coming up, we're firing up an analysis on struggling grill maker Weber after its latest earnings report. You're seeing the stock there catching a little bit of action here in the pre-market after its earnings report, outlining a new cost reduction plan. We'll have more next. Grill maker Weber out with earnings, all after a tumultuous few weeks that included several legal battles in the ouster of its CEO. And this was a challenging quarter for Weber. Now, they pre-announced this quarter a couple weeks ago, but I want to lock in on one key line item on their balance sheet. Yeah, maybe very boring, but nonetheless very important if you're looking to invest in this company. They ended this most recent quarter with only $40 million in cash ahead of the back half of the year. That is a major red flag, and perhaps not a surprise that they're flagging a new cost reduction plan and a cash conservation effort that they're hoping brings in $110 million in cash. But this company needs cash, and they need it quickly.
Yeah, I was looking at earlier, the company came public back in, it's the class of 2021, as I keep pointing out. August 2021, $14 a share. The stock closed on Friday below $7 a share, so it has been halved. So again, you get into the discussion of what it has been grilled. You get into the discussion of what's been priced in. The company at its shareholder meeting approved a plan to get rid of its dividend or suspend its dividend. That's part of that cost reduction plan. But is that going to be enough to help it build up that cash position? I guess we'll see.
Yeah, two things here, and they're kind of correlated because when we think about the number of consumers that had been looking to really upgrade that in-home experience or the backyard experience over the course of the pandemic when you were spending more time at home, pull forward so much of that demand right now, and almost to a point where it's so abnormal that you have a vacuum effect that has really impacted this grill replenishment rate, which we were talking with Simeon Siegel of BMO about last week, because this has impacted Traeger. Now you've got Traeger and Weber both saying that we're going to look across inventory and pull back on exactly where we're even producing grills, knowing that we've already served so much of the demand that's out there. And so why continue to add into the supply side?
I wish I could help these brands out. I just have a one-bedroom co-op. I can't have a grill in my place. I would love to buy a Traeger, maybe stick it in my kitchen, stick a Weber in my living room, really try the smoke pellets and the barbecue grill type variety. But look, and these are declines across the board. I mean, sales down 21%, down in the U.S., down in Europe 24%, Asia Pacific down 5%. Yeah. I mean, these are stunning declines for really two category leaders. It's not just Weber. I mean, it's Traeger too. I mean, these are the main players in this industry, really just likely seeing declines, not just for this quarter, perhaps well into next year.
Yeah, it's because of the GRR. There's no grill replenishment rate to your
I like that, the GRR.
The GRR, the grill replenishment. I mean, listen, I've got a backyard, but I already have a grill.
What type of grill do you have? Is it a pellet?
It was the prior owners left it there.
Well, now you need a new grill.
They're going to be on sale.
It's a gas grill. I have a gas grill.
I see you as a Traeger person. Maybe wood pellets.
Well, so the smoker grill combination, right?
Yeah.
Yes.
And you control it with your phone. You control it with your phone.
Sure. Yeah. At some point.
We're selling her hard.
Not anytime soon. But we'll talk about the.
We'll take it offline.
We'll talk about that later.
We'll take it offline.
How much does that flow through as well to Home Depot and even Lowe's?
We're about to find out this week. It could be pretty bad.
Also here, let's talk a little cars here with just a few minutes until the opening bell. A Chinese electric car maker Li Auto falling after announcing disappointing second quarter results and a deliveries estimate missing forecasts here. Of course, what's also important to remember in the backdrop here for any of the electric vehicle manufacturers in China is that the mandates are going to be increasing over time here too, so that they could get to this broader goal of 40% of all sales being represented by electric vehicles by 2030 in China. And so, of course, COVID-19, the pandemic, and even thereafter, some of the shockwaves with the variants, that it also impacted the ability to produce. But now, as you see more of the Li Autos of the world, the BAIC as well in China, really prioritizing their EV production push, that's where it's going to be even more of that competitive environment. And I think the big thing here on the day is Li is down because of the deliveries. The deliveries were down year over year, and even, well, not year over year, sequentially, I should say.
Yeah, and the margins too down sequentially, sales down 8.7% sequentially as well. And I would say this company is just not winning the sexy battle in the EV spaces coming out from China. You have XPeng working on flying cars that might come to fruition over the next 10 years. You have Tesla dominating the China electric vehicle market. And then you have Li Auto and NIO just floating around out there.
Well, Li only has two cars, right? The two models that are actually not two cars, two models of cars that are out right now. So that's something that maybe is holding them back versus the others. In addition to that, Li's production is more centered in the Shanghai region than some of its competitors, and that's where we have seen most of the shutdown. So their production has really been crimped by that. So that's something that has hurt it as well. So, you know, to your point that they've got this big target of how much they want to capture of the global EV market, maybe they'll get there at some point, but they're going to have to accelerate.
Vroom, vroom.
All right, there you've got the opening bell here on this Monday morning. And Getty Images is ringing the bell. I mentioned that because we're going to be talking to the CEO a bit later in the program after that storied brand, I think we can say, came public again, returned to the public markets through a SPAC deal recently.
You know where that picture? It's getting uploaded right to Getty Images, and maybe we'll put it in our story when we write it for our
probably
site.
like a dozen of those at least. And that's part of how they make their money.
That's true.
It's from People like us, organizations like ours. If we take a look at the opening bell prices this morning, we do have a little bit of a pullback in the major averages here. Retail, obviously, as we've been talking about, it's going to be very important this week in terms of determining whether the rally that we have seen from the June lows does continue. There's a lot of debate right now about whether those June lows were the lows or not. We've been talking to a lot of folks about that, and there's a lot of debate on that point. There is no debate that meme stocks have returned as of late. One of them is a company called, well, the artist formerly known as Sundial Growers, that is now formally renamed itself as SNDL.
Yeah. Silicon Valley move right there.
Do we still call it Sundial, though?
I call it Sandal.
So the corporate name is now SNDL for this company, which is a distributor of alcohol and cannabis in Canada. This is the largest liquor seller in Canada now, actually, after an acquisition that they made. The company coming out with revenue that beat estimates. It reported after the bell on Friday, which is interesting. You don't get too many companies that do that. And so the shares are down a lot over the past year, by the way, but they are getting a little bit of bump up. And this is definitely memed.
Yeah,
has been memed.
These, I mean, they're to your point, Julie, major player.
It's down this morning. I thought it was up.
Yeah, major player in the liquor market.
Earlier,
I mean, gross revenue for their liquor business, $148.6 million. They're operating under the brands Wine and Beyond, Liquor Depot, and Ace Liquor. I mean, all three places I would go to if I was in Canada. Makes sense to me.
Well, I mean, it's been the big question of how regulatory-wise it's going to be a more favorable environment, and there's been so much logjam even on the top. Even if you have people on both sides of the aisle that are saying, yeah, we support this and our constituents want this, it's still not moving forward on a legalization perspective more broadly federally, and that impacts anybody like a Sundial, anybody like an Aurora Cannabis, anybody like a Kronos Group even. And so with all of that considered, that also has an impact on some of the investments that even the traditional companies have made that were looking to get into the cannabis space through infused beverages. And I think across the board, whether you're vertically integrated or whether it's a stake in a company that you've taken, that still is a headwind risk on your balance sheet that you're holding on to right now.
Yeah, I'm glad you mentioned the beverage space. One of the top stories all weekend here at Yahoo Finance, and still the ticker's still trending, is Tilray. We go back to what Tilray, and it linked the story that is getting a lot of attention to what Irwin Simon, when he came on about a week and a half ago, 2 weeks ago, talked about potential for the cannabis market. I mean, the streets, the investors just eating this story up here on our platform.
Yeah, I don't know that Sundial has specific plans to get into the U.S. if there's legalization here. They seem to have really staked a flag in Canada, especially with that liquor business, which is something that other companies, I mean, Tilray's in the beverage business in the U.S. It is not in the cannabis business in the U.S., but it is in the beverage business. I mean, the thing about cannabis legalization is, like...
Is it going to happen?
Right. I mean, I think, the thinking has always been it's going to happen eventually.
Right.
Inevitably, but like when is important.
Yeah.
And it seems like the ship has sailed again this year, and then it's not going to happen this year. So these guys are still going to have to wait. Yeah.
Well, coming up, everyone, Bitcoin briefly tops $25,000 for the first time since, get this, June. Is the correlation with stocks here to stay? We're live at the New York Stock Exchange with more details. That's next. Welcome back to Yahoo Finance Live, everyone. Weak data out of China is the main catalyst for the market moves that we're seeing this AM. We are mixed right now. The Nasdaq has snuck its way into positive territory right now, flat just barely to the upside there. Let's get on down to the New York Stock Exchange floor, where Yahoo Finance's Jared Blickery is standing by. Jared, great to see you. What are you seeing in the tape early this morning?
Well, I'll tell you what, it's great to get a 30,000-foot perspective here when I've been away for a couple of weeks. I'm looking at the Wi-Fi Interactive, specifically at the S&P 500. This is a year-to-date chart. Last time I was in, we were about halfway through. We had just cleared the resistance at about 3,900. Now we are on our way up. Now the big question for the markets is, how much further do we have to go? One of the things I'm looking at today is the strong US dollar index. Now that is a dollar strengthening trade, but what's also concerning, we also have a yen strengthening trade. Looks like my Wi-Fi Interactive connection is a little bit slow right now. But if I had my currencies heat map, I would be showing you that there is strong dollars flow into the yen, not only from the dollar, but from the euro and from the CHF. That is a Swiss franc. So all of that points to the fact that we do have this tremendous short covering rally underway. However, it may give way to some weakness. Now we have some incredible flows coming into the market. I do have a note from Goldman Sachs. We got, well, let's look at this. Systematic demand, 5.5 billion per day this week. Estimate $5.5 billion worth of corporate demand, equity inflows, 2.2 billion per day. So all of this is a tailwind. However, we are still in the middle of this very illiquid summer market, guys.
Speaking of illiquid summer market, one of the other, I don't know, whipsaw kind of moves, although even with a lot of liquidity, this one moved around a lot. I'm talking about Bitcoin. It briefly touched $25,000 Sunday. So what are the technicals telling you about where it goes now?
Well, I'll tell you what, 25,000 was a big psychological level. Also, since we do have a short-term uptrend here in place, maybe even an intermediate term, that was a price target. However, let's remember, we fell through 25,000 very quickly. When we were at 30,000, we dropped to 20,000 very quickly. That means there is not that much price memory at that level. So what we need to do on a short-term basis, not only 25,000 have that insights, but also 30,000. Once we're able to reclaim 30,000, then we can start thinking about some of those next big levels. So in the meantime, 25,000, nice to see those dollar moves into Bitcoin, but I was mentioning the strong dollar before. Now the strong dollar is not only bad for commodities, not only bad for multinationals, but it's also bad for cryptos because that is the denominator. When you take a look at our crypto ticker, US, it is BTC over USD, that is a denominator. So bottom line, the dollar trade, if that's picking up, the dollar strength trade, if the yen strength trade is picking up, all of these risk moves that we're seeing here are probably going to falter. In the meantime, enjoy the short covering rally, guys.
And we are enjoying having you back, Jared Blickery. We'll talk to you soon.
Thank you.
All right, time for your stat of the day. Despite the rally off the June lows for big cap tech names, some of the more prominent stocks in the space are still not having a great year. The FANG complex, which includes Facebook, Apple, Amazon, Netflix, and Google, have lost a combined $827 billion in market cap this year. Apple has been the best performer of the group, down only 3% on the year. Netflix has performed the worst with a plunge of 58%. Straight ahead, the Inflation Reduction Act may not do much to actually lower inflation. We're back with more on that with JP Morgan's Michael Feroli next.
With inflation rising at the highest level in 4 decades, the House gave final approval last week to President Biden's Inflation Reduction Act. It's meant to tame the price hikes that have hit American households this year. But will it actually do that? Our next guest says the answer is likely no. Joining us now to discuss, JP Morgan's chief U.S. economist, Mike Feroli. Mike, it's always great to see you. And of course, seems to be sort of the consensus here that the so-called Inflation Reduction Act, right, this is a bit of marketing. It's not what it's actually going to do. But are we talking about even in the longer term that it's not going to have these kinds of positive price effects on the U.S. economy?
You know, in the longer term, it could. And again, not trying to make broad comments here about the advisability of the act itself. But I do think there are potentially some benefits to the supply side of the economy. Now, that said, in the longer term, in theory at least, inflation should be under the control of the Fed. And that is who determines at least long-run inflation. So even if it does have a long-run supply-side benefit, to have inflation under control, we need to have a Fed that's focused on doing that. But I think the more visible thing is that in the short run, we don't really see much of an effect, because in the short run, the effect on both spending and taxes, or the net of those two, doesn't really do much to either add or detract from the growth outlook. Nor do we see big indirect effects through things like changes in drug pricing, in part because the way the act got scaled back by the parliamentarian at the last weekend. So, for the horizon over which these things are kind of visible, which is like maybe the next year or two, we just don't see really big effects on either growth or inflation, for that matter.
I guess, Mike, continuing down that thought process as well, how soon could consumers, even if this is signed into law by Biden this week and then spending gets fast-tracked, how soon would consumers actually notice the difference?
Definitely not this calendar year, and I'd be surprised if even next calendar year. A lot of the things aren't going to really even affect consumers all that much. So the taxes will mostly be at a corporate level, of course, and the spending will take place over quite some time. Now, some of that will come in the form of tax credits, but for most of that is directed to businesses, utilities, and others. So I wouldn't expect consumers to really notice as much. I mean, I think they're going to see what's going on in the energy markets more recently, much sooner than they're going to see anything from this.
I don't know. Maybe they'll notice when they get a tax break on the below 55,000 assembled in North America electric vehicle.
Oh, burn, Julie, burn.
That's one example. No, but I mean,
Sure.
it's very specific. Anyway,
I got
go ahead,
it.
Sas.
Michael, what just stepping back here, looking at your growth estimates, where are you at on GDP for the third and fourth quarter, and what are your estimates? Are what are they looking like for to kick off next year?
Yeah, so third quarter we're at 1, fourth quarter 1.5. Which would be better than what we saw in the first half of the year. We do think the consumer should get a little bit of relief here from energy prices. So Wednesday we'll get retail sales for July. Given what we already know about inflation for July, could be off to an okay start for real consumer spending in the third quarter. So we're feeling all right about that. That we return to positive growth territory. I mean, the Empire State Survey report this morning doesn't really point to a boomy quarter, but we do think we get back to positive growth. And I think that should continue in the fourth quarter, given the projected path for headline inflation, as well as some of the normalization in supply chains could actually be not only beneficial for inflation, but also for growth, particularly if motor vehicle production comes back like the automakers are anticipating.
Mike, what happened with that Empire manufacturing number? Why was it so lousy?
Earlier I think in your segment you were talking about the strong dollar. The one sector of the economy that's going to hit the hardest is manufacturers. So that may be one factor there. Empire State had been looking a little better than some of the other regional Fed surveys, so maybe it's just catching up a little bit. I wouldn't want to put too much emphasis on, like the point estimate coming out of the Empire State, but generally speaking, I think it's reasonable to expect that manufacturing will face some headwinds here. Again, the strong dollar really means that factory sector is ground zero for the economic impact there.
One of the other kind of events that's worked its way into the conversation is the reasonable expectation, and I put a question mark around that because a lot of people are talking about whether or not the Fed should be prompted to actually have a rate cut at some point early in 2023. Is that something that should even be on the table for discussion right now? Do you believe that may happen, and what would have to even take place?
So I would be surprised if it's actually on the table at the Fed anytime soon. I think they have been pretty clear that they need, compelling evidence that inflation is actually moving down and not just forecasted to move down. So we're a pretty long way from there. We had a nice suite of inflation data last week, but still a lot of work to be done, particularly in getting the labor market back into better balance, which hasn't really even begun. So look, as we've seen over the past couple of years, anything can happen in the space of 6 months. That being said, I think under most expectations, it's going to take quite a while before they can be comfortable getting rates back down. I think for now, the first order of business is actually to get policy rates into restrictive territory. I mean, after last month's hike, they're basically just back to neutral. So with the economy running as hot as it is, you have to get policy rates restrictive, I think, before we can even start to talk about getting them back down to neutral, which I think before we see that, we're going to need to see, inflation numbers that are even softer than what we saw last week. I mean, last week, the 0.3 we got on the core CPI was nice, but we'd probably like to see it even lower than that in a world where the Fed is going to be comfortable actually cutting rates. So,
I mean, do you think we're going to get that anytime soon? I mean, we keep, I know you're a macro guy. We try to do both as much as we can, and we keep hearing company after company telling us demand is softening in a lot of different areas, from apparel to appliances to consumer electronics. Mm-hmm. One would think that is going to have some feed through into prices.
I agree. And I think we're already starting to see evidence that prices for goods should be moving down. So we've seen weakening import prices. We've seen supply chain improvements in terms of like delivery times. So I think it's a pretty relatively safe bet to think that goods prices should be softening in coming months, and perhaps we'll see that with some of the retailers tomorrow. And we know that inventories at general merchandisers is pretty elevated. So I think that's one part, but goods are only like 1/3 of the consumption basket, roughly. So you've got rents that have been running very strong, and that should persist for quite some time. And a lot of the other service prices have been kind of picking up too. So I agree that what you're probably going to hear this week is retailers saying consumers are under a little stress, they're a little more price sensitive. But I think we also need to see things like, again, rents is such a huge component of the price basket that we need to see that soften, and a little bit of early evidence in some of the company reports from real estate companies that we're seeing some easing up of the imbalances in the rental market, but I think that's still early innings in terms of getting a more normal rental market.
Yeah, doesn't feel like that is on the imminent horizon. Thanks so much, Mike. Good to see you. Have a great week. JP Morgan Chief U.S. Economist Mike Feroli there. And coming up next, Saz is going to share his take on Bed Bath & Beyond struggles. At the risk of drawing the ire of Twitter.
Bring it on.
We'll be right back. Bed Bath & Beyond is facing criticism on Wall Street as of late. On Friday, Loop Capital analyst Anthony Chicumba came out with a note reiterating his $1 price target on the stock, predicting the retailer will go out of business. That's where we find Sazi's take today. Sazi had a nice, relaxing, leisurely weekend visiting Bed Bath & Beyond.
Yeah, it's how my weekend rolls. But look, I just want to say this up front. You know, we put a piece out on Yahoo Finance this morning, running a lot of photos of what I found in these stores. Before I even go through some of these photos, I've been getting a lot of tweets this morning. I think I'm up to 25 tweets, but it might be folks on Reddit, investors in Bed Bath & Beyond. It is the top ticker on our site. The shares were up close to 20% in the pre-market. I am not invested in Bed Bath & Beyond. I am not short the stock. I'm just out here reporting. No one is paying us for this story. So let's get real here. Stop tweeting me this garbage. It's ridiculous. But some of these photos you're seeing on here, I visited 2 Bed Bath & Beyond stores in Long Island. One, my hometown Bed Bath & Beyond store. It was tough to see in this shape. But a couple themes that stood out here. High levels of clearance items. It's not a good sign when a company like Bed Bath that ended its most recent quarter with $100 million in cash before the holidays. You walk into the stores, you see empty shelves, you see not just entire departments devoted to clearance and sale items. The discounting is pretty deep. I mean, they're offering window treatments, for example, at 80% off. Also, a lot of the private label goods that were put into the store by now former CEO Mark Tritton, these things are not selling. They are all on sale, 30, 40, 50% off. These private label products are not moving, which raises the question if deeper discounts will be needed very soon to get this stuff out the door to bring in that cash.
Or will they take write-downs?
Or will they take write-downs, Julie? You're right on, to bring that cash into the business and then ultimately get more brand name stuff that the consumers have known Bed Bath for, get that on the shelves ahead of the holidays. And it was just a very disappointing shopping experience in Bed Bath. And I should mention, and this is weekend, great weather. People were out there shopping. I went to visit Roosevelt Field Mall. Mall was packed. These stores were empty, which is a big, big red flag. So overall here, we're going to fire up my take on Bed Bath & Beyond. It could be a challenging couple quarters here for the company. It could be about to get very real. And there I am. Sleeping.
Are you pulling the covers up over your face because you're too afraid to look at how bad it is?
I covered the downfall as an analyst and then as a reporter for Sears, Kmart, not Borders per se, but Sears and Kmart weren't my main stories way back when in 2013 and 2014 when things were really getting bad. And I had that feeling walking into these Bed Bath & Beyond stores. They hit it a little bit better by not putting out, deep clearance, deep sales, but still the evidence of a struggling retailer were on full display here. Now the stock is rising here in the pre-market as the meme crowd gets control of it, but still a lot of red flags in these stores.
Yeah, continue to watch Bed Bath & Beyond. The deep discounting, the clearance photo was one that stuck out to me that you took because there was a lot of inventory even in that section, and so we'll see exactly how they start to work through some of that inventory. We're going to continue to talk about retail, though, all week with our retail roundup as well coming up. We're going to break down some key earnings and economic data to watch out for that's hitting over the course of this week. That's next.
Welcome back to Yahoo Finance Live on this Monday morning. I'm Brian Sozzi here with Brad Smith and Julie Hyman. Markets have lots to digest this morning, including an interest rate cut out of China, but all eyes will soon turn to results from big-name retailers like Target, Walmart, and Home Depot later on this week. Right now, we're seeing some mixed action across the board. Nasdaq has turned slightly green, though. Now, here are three things we're watching for you right now. Yahoo Finance contributor Kevin Cirilli will tell us what he's watching on Capitol Hill following the president's Inflation Reduction Act win. Shares of Plug Power are making a U-turn back to January levels as the Inflation Reduction Act awaits signing by President Biden in D.C. The bill would provide billions in funding and tax credits to the hydrogen economy. Plug Power CEO Andy Marsh joins us soon to chat. And we'll check in with Getty CEO Craig Peters as we welcome the 27-year-old company back to public markets. Its shares have caught a bid after completing a SPAC merger at the end of July. Brad, over to you.
All right, you mentioned some of the major averages. Let's take here a look at some of those major averages for the Dow Jones Industrial Average right now. Still flat, just barely to the downside, about 31 minutes into trade here on this Monday as we kick off a new trading week. The Nasdaq Composite, though, you mentioned that that's barely in positive territory, and that's exactly where we find ourselves right now, up just about 7-ish points there. So we'll see if we can hold on to that and perhaps build on some of that move higher most recently here this morning in that slight candlestick higher. And then additionally, just checking in on the S&P 500, you're also seeing that right now in negative territory. So mixed right now and hyper oscillating for some of the major averages, but for the S&P 500 down by about 0.1%. I want to take a look at the heat map here real quick to see exactly where we've got some of the biggest movement taking place here today. I've been keeping an eye on some of the semiconductors here. You're seeing NVIDIA having a decent day thus far. It's up by about 1%. Also AMD up by about 0.5%. But then additionally, as we start to get into some of the other big tech names here, you're seeing even a name like Tesla here on the day. TSLA, that is up by about 2%. Some of the other major movers shouting out Moderna here as we keep a close eye on that. Shares popping there by about 4% on today's activity. And then additionally here, let's also just take a look at Gilead as well, rounding out some of the broader biotech space. You're seeing that up by about 2.7%. So keep a close eye on some of those names as we move on throughout the rest of today's trading activity. You could see them trending on the Yahoo Finance platform as well online. Everyone switching gears here. Last week's inflation reports came in softer than expected, but we're still far above the Federal Reserve's 2% objective. Our next guest says that the Fed has plenty of runway beyond 2022 to rein in inflation. Hugh Johnson, who's the economist and chief investment officer over at Hugh Johnson Advisors, joins us now. Hugh, great to have you here with us today. Help us break down and add perspective to what you're seeing play through in the markets and what exactly the Fed pathway may be going forward from here that the markets will still have to digest over time.
Well, what I think or hope that we'll see from the Federal Reserve is certainly not what we're hearing from members of the Open Market Committee or what they think is lies ahead. You know, obviously we got the good inflation numbers that we had for the month of July. I think you should keep in mind that the month of August are going to be equally good. In other words, inflation numbers are going to be soft. And probably for the coming months, they're going to be soft. When we get to the end of 2022, we're going to be looking at, say, 6.5% to 7% year over year numbers. And when we get into 2023, they're going to be materially lower than that. In addition to that, some of the signs we're getting from things like the leading indicators tell me that the economy is in the process of slowing. You're not going to see employment numbers that are as good or strong as we saw for the month of June and July. What you're going to see is the numbers are going to be coming down and coming down pretty swiftly. So we're going to have soft economic numbers. Now, what I would like to see is that the Federal Reserve, this gets reflected in Federal Reserve interest rate decisions. But when you listen to what they're saying, members of the Open Market Committee are saying they're just as hawkish as they've ever been. And they're going to continue to raise interest rates continuously until they get that rate of inflation down at 2%, which I don't think they can do. But nevertheless, they're very intent on doing it. So the Federal Reserve is saying right now that they're going to be more hawkish than I think they should be. And when we get into 2023, when we start to see really soft economic and inflation numbers, we'll just see what they do.
So Hugh, you think this is just wishful thinking, this view that has become embedded in the market of a dovish pivot by the Federal Reserve?
Well, if you take seriously what they're saying, you certainly would say that's probably a pretty dovish view on my part, or optimistic, or too optimistic a view, and that they're not going to pivot, or they're not going to pause, or they're not going to go a little bit easier on raising interest rates, particularly when we talk about September. There's still people talking about 75 basis points. I think it'll be 50, and talking about 50 basis points in November. I think it'll be 25, December 25. They say they're going to be as tough as they've been. I don't think so. I think they're going to come off of that. Otherwise, they're risking the same mistake that we see so continuously in financial market history of, you'll remember the word overkill. You might hear that word again.
Well, and their mistake going into this was on the opposite side, right? That they were sort of too late to begin raising rates when we were starting to see signs of inflation. So what gives you the confidence that that they've learned, I guess, from that mistake of not being responsive enough in the past?
Julie, that's a great question. It's when you listen to what they're saying, it tells me that they're going to be just as hawkish or make some of the mistakes that they've made in the past. When they talk about the importance of a 2% inflation rate, look, if inflation gets down to 2.5%, and you're a member of the Open Market Committee, and you're seeing very soft economic numbers, very soft inflation numbers on a month-to-month basis, what are you going to do? You can either be humane or you can stick to your guns and say it's got to be 2%. If you stick to your guns, and they've done this in the past over and over again, stick to your guns, then obviously we're going to have a risk of a very, very hard landing. Keep in mind, Julie, index of leading economic indicators have been down 5 successive months and are telling us that we've got a real risk of a hard landing. The numbers we're looking at for the quarter-to-quarter numbers for the next third quarter, fourth quarter this year, first, second next year, we're looking at numbers like 0.9, 0.7, 0.6. That's pretty close to a hard landing. And then you've got to be a little bit sort of flexible, shall we say, or responsive to the inflation and the economic numbers that we're going to see for the remainder of 22 and the early part of 23. They've got to be flexible because otherwise they're going to make a mistake.
Do you think that on the pathway to their inflation targets, they can maintain the employment situation that we've also seen?
No, you're not going to see the employment numbers that we've seen, I don't believe. In other words, we're not going to see numbers that come down a little bit from the prior month, but not a whole lot, and they maintain real strength. Look, at the employment numbers are going to come down, and I worry. Look, everybody forecasts these numbers, and everybody forecasts them differently. I see numbers that are pretty close to average monthly gains in non-farm payroll employment of 100,000 per month, and maybe even less when we get into 2023. Those are not very good numbers. So I don't believe that in their pathway to 2% inflation that they're going to be able to, at the same time, maintain or keep employment numbers on a monthly basis up. We'd like to see them at 150 to 200,000 like they were before the pandemic. I don't think they can do that based on what they're going to do right now. I don't mean to be very negative, but I must admit I'm very concerned, and I'm obviously familiar with financial market history, and I've seen all the mistakes that they've made, and I see the rhetoric being very consistent with the mistakes they've made in the past.
So just quickly, Hugh, what are the implications of all of this for stocks?
That's the interesting part, is that if they do what I think they're going to do, if I think they're going to, I don't want to use the word cave, but give in, I think in time, we're going to start to see numbers that say that the economic slowdown, we'll call it a soft landing or hard landing recession, is going to turn for the better, that things are going to start to improve. We're going to have a recovery. The stock market under those conditions will start to discount 2023, the earnings for 23, the earnings for 24, and the stock market will do better. That's like a normal cycle. But what has to happen for that cycle to resurface is that we have to see the Federal Reserve be flexible or try to get the soft landing that they say they want to get. They have to be flexible. Otherwise, we're not going to get much from the stock market. If we do get that, we'll get something from the stock market and watch the consumer discretionary and technology stocks under those conditions.
We'll be watching all of that. Hugh, it's great to get some time with you. Good to see you. Hugh Johnson, economist and chief investment officer at Hugh Johnson Advisors. Good to see you.
Pleasure.
Well, fresh data from the retail sector could be the latest catalyst for markets. Here's Yahoo Finance's Alexandra Semenova with what we're watching this week on Wall Street. We've been talking a lot. We're really excited about these retail numbers.
Yeah, news out of the retail sector could be the latest data to drive markets higher this week, or of course lower, depending on how things go. A series of better than expected economic prints recently have really lifted sentiment on Wall Street. So investors will be watching the Commerce Department's July retail sales report closely on Wednesday, and we're expecting to see some moderation over the month due to lower gas prices. But core retail sales activity is expected to hold up over the month and show that consumers continue to spend money despite the inflationary pressures that they're facing. And of course, we also have a number of major retailers reporting earnings this week. Walmart, Target, the Home Depot, Kohl's are just some of the names on tap. And needless to say, traders are getting ready to be unimpressed by the numbers, expecting to see continued pressure from inflation on their margins. Walmart will set the tone tomorrow before the opening bell, coming just weeks after the company slashed its outlook and also announced plans for layoffs. We're likely to see more information on that theme as well as in other retail peers. And two things to look out for, of course, are what companies are saying about their built-up inventories as some consumers have cut back on spending, and what they're saying about back-to-school season, which could give some retailers a much-needed boost. And as if investors don't have enough on their plate, we'll also get minutes out of the Federal Reserve's last meeting this week, and it could offer some insight about what policymakers are thinking for this fall and whether we've seen peak hawkishness with that last 75 basis point hike.
Yeah, that Kohl's quarter could be tough to look at, but we've had a rally. Despite all this bad news, stocks have caught a bid from the lows. What are you hearing from folks?
Yeah, well, we just saw stocks cap their longest winning streak since November. The S&P has now recovered about half of its losses since plunging from its all-time high in January. So there's reason to be optimistic about this rally, but Wall Street still appears to be torn about this. JP Morgan says that it's going to be sustained for the rest of the year, whereas Morgan Stanley coming out and saying that this is just a pause to the bear market, that the same headwinds remain, economic pressures, worries about the Federal Reserve, inflation, all of those things will continue to weigh on stocks for the rest of the year.
Alexandria Simonova, thanks so much.
Thank you, guys.
All right, we're keeping an eye on shares of Apple as the company's ticker page in Yahoo Finance is seeing strong traffic. The attention comes on a Bloomberg report that Apple may start pushing ads to other services such as Maps in a bid to boost profits. The company already offers ads on its App Store, news, and stock services. Apple didn't return Yahoo Finance's request for comment on the report. Apple shares are up 6% so far in August, outperforming the Nasdaq Composite's 5.3% gain. Coming up, the gusher in oil prices led to a banner quarter for Saudi Aramco. Julie's back with the numbers and a rundown of the top headlines this morning. Next.
Some other headlines we're watching right now. Saudi Aramco saw a 90% jump in quarterly profit, marking its highest quarterly net income since going public in 2019. The profit happening, of course, on the back of higher crude oil prices, as Saudi Aramco generates billions in cash for the Saudi Arabian government. In the second quarter alone, Saudi Arabia's GDP grew 11.8% year over year. By the way, Aramco also did not raise its dividend as a part of this big earnings report. Tesla has officially passed the 3 million vehicle mark for production. That's according to a tweet from CEO Elon Musk. Musk congratulated the Giga Shanghai factory for making its 1 millionth car over the weekend. This follows months of shortages and lockdowns in China due to the country's COVID policies. In July of this year, Musk said the Fremont, California factory had produced 2 million cars. Facebook users will soon be able to order food delivery from Facebook Marketplace. That's thanks to a new partnership between Meta and DoorDash. The two companies said they have already tested services in several U.S. cities, but that the partnership is still in the early stages. This is the latest bid by Meta to get more young people to use Facebook Marketplace. Brad?
The U.S. is coming up on the anniversary of the Afghanistan withdrawal. For more on why this is significant for the Biden administration and what the situation is 1 year later, let's bring in Yahoo Finance contributor Kevin Cirilli. Kevin, help us break this down.
Yeah, it's the 1 year anniversary following the United States withdrawal from Afghanistan. And quite frankly, the Biden administration is getting bipartisan criticism, something that's pretty rare. Now, the top Republican on the House Foreign Relations Committee, Mike McCall, Republican from Texas, he was on the Sunday shows over the weekend, Face the Nation on CBS, and he said, quote, "There are many sins, if you will. There was a complete lack and failure to plan. There was no plan, and there was no plan executed." Now, this is important because he just came out with a report in which he found that 70,000, let that sink in for a second, 70,000 Afghanis are still in Afghanistan and have applied for a visa, a U.S. visa, to get out of the country. Now, Adam Schiff, he's a Democrat from California, chairman of the House Intelligence Committee. He has also said that there are questions that need to be answered regarding the withdrawal from Afghanistan. However, he did point to some of the success that the Biden administration has had, particularly for the killing of the terrorist Zawahiri, in terms of getting that executed. And it shows really the precise ability for the U.S. military to take a target out.
And Kevin, you're also still watching Taiwan.
Yes, and just over the weekend, we got news that another group, a bipartisan group of lawmakers, has touched down in Taiwan. This, of course, after Speaker Pelosi's historic visit, and as the Chinese Communist Party continues to hold military exercises in the Taiwan Strait. This was led by Senator Ed Markey, a Democrat of Massachusetts. He was accompanied by Congressman John Garamendi, as well as Don Beyer, as well as another group, a handful of other lawmakers. But it also comes following the news over the weekend that 5 Chinese companies are going to delist from the New York Stock Exchange. And as reportedly, President Xi of China wants to get this, a face-to-face meeting with President Biden sometime in November. Now, Xi Jinping hasn't traveled in nearly 3 years as a result of those zero COVID lockdown policies in China. Obviously, Xi and Biden have a lot to talk about in November, and that's going to be carefully watched. Now, the Biden administration has said that this did come up in their last phone call, but so far, no official concrete plans for the two leaders to meet. But they're talking about meeting, so I guess that's a step forward.
Yeah, and it'll be interesting to see where they choose to do so, to your point about travel. From China to Wyoming, where tomorrow incumbent Wyoming Congresswoman Liz Cheney is going to defend her seat against a Trump-backed opponent in the Wyoming primaries. Why is there so much attention being paid to this race? Why is it so significant?
Well, this is, it's like Yellowstone meets House of Cards, okay? Because no one really expects for Congresswoman Liz Cheney to defeat MAGA-backed candidate Hageman, but it does set up the contours of the next 2.5 years, especially in the 2024 presidential primary. Now, I did speak with a prominent Republican bundler just the other week who said essentially to me, Liz Cheney inherits those independent voters who left the Republican Party, who are deeply, deeply skeptical of what the Trump base, so to speak, has done to the Republican Party. These are fiscally conservative voters. These are voters who are very worried about America's standing in the world on geopolitical issues. And they are folks who really want to see the Republican Party get out from under the grip of the fringe movement, as they would describe it, of conservatives. But regardless of what happens in Wyoming, don't forget about Alaska, because Kelly Tshibaka, who is another MAGA-backed candidate, she's running against Senator Lisa Murkowski, perhaps one of the most influential Republican moderates in the Senate. But this is where it gets really interesting, Julie, is because Alaska has those ranked choice voting. So even if Murkowski finishes second behind Tshibaka, she would still be able to get to a primary and honestly would have a much better chance, because they've changed their primary rules. This is an interesting bellwether and a case study, so to speak, because the way that Alaska has modeled their primaries could actually end up being how other states follow. So keep an eye on Alaska as well. So, I got to say, I do kind of miss these primaries and the campaign trail a little bit. So Tuesday's a big day.
It would be fun to visit Wyoming and Alaska as well if you were doing it doing that coverage in person.
We're all out there, and I'm like, I'm starting to feel a little like I'm missing out a little bit.
Nostalgia for the campaign trail. Never thought I would hear it from you, Kevin. Thanks so much. Good to see you, Kevin Cirilli, a Yahoo Finance contributor. All right, let's take a look at two trending tickers now. Shares of Disney are moving higher. Shares of Amazon moving a little lower. Let's talk about Disney first. Dan Loeb's third point, taking a new stake, a renewed stake. And that is according to a letter that was put out by Loeb here. Remember, Loeb, in his third point, had a stake in Disney, then exited that stake in March. And now he's saying they've taken a significant stake. We don't know how much it is. It's likely below 5%, because if it was above 5%, that would trigger a filing. But they are now filing to become an activist investor and are pushing for some changes. And it's funny because Loeb kind of says, you guys might already be working on this stuff, but it might be non-public material information, cost cutting. He wants them to not pay their dividend. So some changes that he's pushing for here. I'm
still trying to figure out if Dan Loeb has the same juice as he did. I think we're past peak Dan Loeb and where he was 10 years ago. The real activist investor firm on the street, that's Elliott. You want to get things done? It's Elliott. Look what they're doing with PayPal. But just going on here through this letter that Loeb put out here, they want them to spin off ESPN. Not a new idea. I think they've been talking or thinking about that internally at Disney for some time. A lot of folks in the street have put that out there. But here you have Dan Loeb pushing that.
Yeah, using some of their kind of dividend policy to pay down debt, repurchase shares, or organically reinvest in the business. I think for Hulu as well, what they mentioned also, and it was kind of congratulatory in some of at least the outset of this letter to say, yeah, we recognize that you are on this path that you've set forth, and it's been a difficult transition, seemingly so. But at the same time, yeah, the spinoff of ESPN, other cost-cutting measures. They are talking about Hulu as well and the unreasonable price expectation at the time, and we know this is a priority for you and hope there is a deal to be had before Comcast is contractually obligated to do so in about 18 months in terms of the minority stake that Comcast still has in Hulu as well.
Dan Loeb, great quarter, Disney. Here's a bunch of ideas that are not new. We just want to write a letter.
Yeah. And be heard.
And be heard.
Yeah.
We had to.
I mean,
it is what it is.
I don't know. Okay. Well, we'll see what happens with that. But anyway, the reason we were looking at Amazon as well is that Seth Klarman of Baupost is taking a stake in that company, according to CNBC. So it's not giving the shares a boost. They're actually moving lower here this morning. But nonetheless, it's interesting that we're finding about these well-known sort of hedge fund guys who are investing in these big companies.
And he's seen as a value investor. So interesting to see him take some position. Amazon, also Warner Brothers too, I believe as well, coming off of their very challenging quarter.
Yeah, absolutely. Amazon and all of both of these kind of intertwined too. Of course, Amazon has so many other businesses outside of what Disney has, but for both of them right now in the media business, where it's going to get even more testy, competitive, and going after sports rights, acceleratingly so as well in the near term, that's where we could see some of that overlap in the types of contracts that they're looking to go after.
Yeah. Well, coming up next, what the Inflation Reduction Act means for clean energy. We're going to talk to the CEO of Plug Power on the other side of the break. Shares of Plug Power are up a bit today, but they did surge quite a bit last week on the back of the company's earnings report. Despite seeing revenue miss expectations, the company got a boost from upbeat analyst calls following the passing of the Inflation Reduction Act. Joining us now to discuss is Plug Power CEO Andy Marsh. Andy, thanks for being here. So just give us in a nutshell what this new law is going to mean for you.
Well, Joey, Plug was on a great track before the new law, where we were target for our $3 billion 2025. But what it does is make the green hydrogen plants, which we're building across the United States, economically competitive with gray hydrogen across all sorts of applications, from fertilizing manufacturer to green steel to green hydrogen for use in peaker plants. It actually just changes the dynamics completely with the $3 tax credit for green hydrogen. Good for Plug, good for the nation, good for the world.
Okay, Andy, so how good? When should investors start to see the impact of this flow through to your bottom line?
As we said on the earnings call, our CFO says it pushes our path to profitability up 6 months into early 2024.
What are customers asking differently from you right now? Walmart is one of your biggest partners as well. And so with regard to the relationships that you have with those customers, where they're leaning further into that relationship, what are you hearing on the demand side?
Well, I think what we're hearing on the demand side, and you could see it, another portion of our business is our electrolyzer business. We're already 50% ahead of what we expect to book for the whole year on August 1. So what we're seeing is tremendous demand for our electrolyzers, which will be used for both here in the United States and in Europe. We're seeing increased demand for our green hydrogen, for the 70 tons of green hydrogen per day that we'll be producing by the end of this year. All that's beneficial to Plug. And we're doing it, quite honestly, because customers like Walmart, Amazon, New Fortress Energy all want us to be producing green hydrogen or building electrolyzers for them so that they could use green hydrogen.
Andy, for potential clients, is the biggest thing holding them back the cost? And is that one of the reasons why this bill could be particularly helpful?
I think cost, it takes it off the table. Now green hydrogen is cost competitive with gray hydrogen. Now green hydrogen can be easily added to natural gas. Yes, I think it is a big driver, which drives a lot of the industrial applications. And in the industrial applications represent 26% of the world's CO2 emissions, which is equal to mobility. It really takes it off the table. We don't have to discuss it anymore. And now we have security. This bill provides a 10-year tax credit for green hydrogen, as well as a healthy tax credit for fuel cells through 2025, which turns to tech neutral after that. So, Plug, and I think the industry, it provides insurance that it'll be around for the long run. So that's why I think folks in both, industrial applications as well as retail applications, as well as mobility applications, are all excited about this bill and really has changed the landscape for our company and others.
Andy, you mentioned you won't be profitable until 2024. So over the next 15 months or so, where are you going to be investing the most? What areas?
Oh, it certainly is in our electrolyzer and green hydrogen plants. I mean, we've announced we're going to be, investing $1 billion for our green hydrogen plants next year. We're obviously, we've had 2 new factories, one coming online as we speak in Rochester, a gigafactory for making, stacks for green hydrogen plants as well as for our electrolyzers. That's where we're putting the dollars today.
You've called data centers a $40 billion opportunity for Plug Power. Where do you start to realize some of those opportunities actually come to fruition, and how quickly does that become accretive to that path to profitability for the business as well?
Well, we've announced that we'll be deploying 60 megawatts of products for the stationary market, which is more than just data centers. Over the coming year, we expect that to be 200 megawatts over the next 18 months. It'll be used not only for backup power, but also for providing power to electric vans, which may seem odd, but it's a big market opportunity. In the long run, fuel cells in these stationary products replace peaker plants. Very much what we're doing with SK, where we'll be deploying 200 megawatts by late 2024 and 400 megawatts per year from 2025 to 2040 with our great partner SK in South Korea.
Plug Power CEO Andy Marsh, always great to chat with you. Good luck on the path ahead. We'll talk to you soon.
All right, always a pleasure. Thanks, guys.
Thanks so
Bye
much.
now.
Have a great week. All right, coming up, Cisco shares in focus after one analyst came out here and hammered the company rating-wise ahead of their earnings. We'll have more on that next. Welcome back. For our first call of the day, we are locked in on a sell rating being slapped on Cisco ahead of the company's Wednesday earnings release. That call comes from Citi's Jim Suva, who is concerned about supply chain challenges and market share losses. Suva is the only analyst on Wall Street with a sell rating on Cisco. I applaud his dedication to his craft and his willingness to stick his neck out there. But look, all signs point to potentially weakish quarter when Cisco reports later in the week. We've seen, of course, we talked about earlier in the show, weakness out of China, a key market for Cisco. We've seen challenging economic conditions here in the U.S. And in Europe. So I understand his call from Jim, certainly into earnings.
And they're reporting what, on Wednesday you said, yes.
Yeah, and you talk about pull forward in demand. I mean, Cisco, WebEx, any telecommunications company that has seen so much of the partnerships or the major deal making for their sales units actually come forward because of the pandemic and the number of people that were using some of those solutions for collaborative purposes. And now you see, as people are coming back to the offices, that's still relied on, but how much are they actually upselling into that client base? And for cost management that many of those partnerships or those clients may be going through, does that mean that they're going to pull back for an extended period of time on the additional purchases, or whether that be licenses or products that they use from a Cisco?
Yeah, those shares, by the way, are down about 27% year to date. Like most everything, they've bounced from the lows, right? They're up only about 11% from the lows. So a little bit of optimism from the market going into the earnings.
Big week of earnings.
Yes.
Big week. Also, let's take a look at another call. Checking in on Dollar General here. BMO Capital Markets downgrading the store chain to market perform as the firm believes that Dollar General's valuation is close to peak levels on recessionary comps. The title of this letter was breaking up is hard to do, and unfortunately priced for perfection is what they added on to here. So the new target that they had put out there, $265 it looks like, and particularly here from Kelly Bania saying that they're downgrading the company because they think that the valuation is close to some of these peak levels on the recessionary comps, as we mentioned. But it's still a strong play right now if you're looking at Dollar General or Dollar Tree, depending upon where some of not just the earnings results for this most recent quarter come in. I believe Dollar Tree is reporting next week, and we'll get even more data out of the mind of the consumer from these reports that come forward in retail this week to really see exactly where they're spending most of their dollars, if you will. And so for Dollar Tree, Dollar General, I think that's exactly where you've got to keep an eye on, is how they're also moving through inventory, even if at a lower price level.
Yeah, and this note brings up a good point. So they're calling out, probably see a good consumer strength, sales strength at Dollar General, but they're concerned about Dollar General being sucked into this discounting that's going on in retail. And if Dollar General has a discount from $1 to 25 cents, that's not good for margins.
Well, Dollar General isn't just dollars.
It's not just, okay, $1.50.
And Dollar Tree started charging above $1.
Yeah, they're above $1.
Yep. Yes. After an activist pressure.
Dollar General, dollar on the name of Dollar General is more figurative than literal,
that is correct.
I believe,
that is
at
correct.
this point.
You're on the mark.
So that's
Should be Value General.
Yeah, so we should watch, but we should definitely watch the margins at that company. All right, and let's talk about online used car platforms, because Vroom and Shift are being hit with a downgrade from JP Morgan as the analyst there continues to see a challenging backdrop for the used car industry broadly. Analyst Rajat Gupta downgrading both companies to underweight from neutral. And by the way, both these stocks, it's not like they're up. Both these stocks are down sharply for the year to date. I think in the case of Vroom, it's about 80%, and Shift is down more than 60% this year thus far. So it hit a man while he's down, I suppose. And so the analysts here are saying that there might be better opportunities within the used car business as things start to improve. He says, we prefer companies that have ample liquidity and or diversity in their business to navigate an uncertain macro backdrop. So effectively, he's saying that these are some of the weakest positioned players in this industry.
Yeah, clearly JPM just downshifting into first gear on both of these names. But yes, that's a takeaway from reading this note, Julie. I don't think the analyst team at JP Morgan just doesn't trust the fact that these companies can make it through without another capital raise. And you look at Vroom, I remember that stock came to market under much fanfare. Both of these stocks, they're essentially penny stocks now.
Well, the question among the consumers, too, is if I'm going to buy a used car and it's already going to see a much higher price year over year and year over two than I would have been accustomed to, and perhaps I'm not even getting the same type of warranty, type of guarantee from that dealership as I could get on a new car, as long as you can find the new car and it's on the lot, then that is just a cost comparison that any consumer would naturally go through, and that's going to directly hit a Carvana, a Vroom, car lots. And so, as all of them are navigating where they've got inventory as well, and the amount of backlog that they're also able to not just get off the lot, but then have more customers continue to come back and make purchases at higher levels on perhaps a lower demand at those levels, I think that continues to just be that near-term headwind that they haven't been able to solve for.
Yeah. In the meantime, JP Morgan says it likes bricks and mortar car dealers because they have stronger free cash flow.
Like Joey down the block. They like that independent owner. There we go. AutoNation, I guess. AutoNation.
They got some good deals down the blocks.
Yeah, down the block.
Shifting gears now.
Literally, shifting
do.
gears.
Yes.
Shifting gears.
To food spending. Your favorite fast food chicken sandwich slightly costs more today than it did 6 months ago. Are we still in the chicken sandwich wars? All right, on pricing, maybe.
Yes.
Despite
apparently.
inflation cooling down in July, food prices continue to skyrocket. According to the Bureau of Labor Statistics, known in your hood as the BLS, July Consumer Price Index, CPI, the cost of food rose 10.9%, highest increase since May of 79. Yahoo Finance's Alexandra Canal joins us now to break down the impact. Okay, chicken sandwich wars here. Let's talk it a little bit, Ali. What's going on here?
I mean, Brad, take my cheap gas, but not my cheap chicken sandwiches. I think that's the moral of the story here. But according to exclusive data that Yahoo Finance, I'm sorry, I'm so verklempt by the chicken sandwiches, but from that Yahoo Finance received from Edison Mail, formerly Edison Trends, you'll see the average price of chicken sandwiches has steadily risen over time, 18% higher on a year-over-year basis. Now, this is based on data from over 240,000 online direct orders from 10 quick service restaurants. And if we dig into that data a little more specifically, you'll see on your screen here that these are individual sandwiches. Now, for example, if we look at the price of both Popeye's spicy chicken sandwich and McDonald's spicy crispy chicken sandwich since January, that has risen 13%. But on a year-over-year basis, Popeye saw a whopping 22% increase for that sandwich. So folks were paying $3.92 in July of 2021. July 2022, they're now paying $4.80. And if you want to take that even further in context, we could look 2 years ago between July 2020 and July 2021. The cost of a Popeye's spicy chicken sandwich, that cost actually decreased by 6%. So down 6% July 2020 to July 2021, now up 22% July 2021 to July 2022. So inflation definitely real here.
I want to like that new Panera chicken sandwich, Ali. I'm just not there emotionally quite yet. All right, Alexandra Canal, thanks so much. Coming up, we'll go down to the floor of the New York Stock Exchange to chat with Getty Images CEO Craig Peters. The company just reported its first earnings report since going public in late July, and the stock has been doing pretty darn well. Don't go anywhere. Locked in on shares of Getty Images today after the company reported its first earnings after going public in late July. The stock is up considerably since closing its SPAC merger on July 25th. Joining us now from the floor of the New York Stock Exchange is Getty Images CEO Craig Peters. Craig, good to see you again. Look, the stock has come out of the gate pretty strong since the debut. What do you attribute that to?
You know, I really can't give you an answer to that. I think, we're focused in on building a business. And it's a business that's been around for 27 years. I think we've got a great brand. I think we have a really solid product that helps, millions of customers, basically get their job done in a more efficient, higher quality manner. And so, I think that's ultimately what underpins this business. And ultimately, I think the stock is a reflection of this business. And that's what we're focused in on going forward. It's just building a great company based off great content and really servicing our customers' needs.
Investors in any company want to hear a good growth story. What is that growth story for Getty, and where do you envision unlocking some of that trajectory?
Yeah, so growth from us is, again, it starts with great content and making sure that we're bringing the very best content to our customers. But there's more and more customers that need our content every day. Most notably, the corporate market is bringing a lot of their presence, their digital presence in-house. And so they need more and more visual content to feed their websites, to feed their social media. They need to do that on a more frequent basis. Increasingly, video is kind of the next leg of growth. It's been a core growth driver for us. We're a business that's in, about selling into about 200 countries, but we still, have more than half of our revenue sitting outside of North America, but there's still a lot of geographic opportunity for us to grow, and we're focused in on that. And then, we made an acquisition about 5 quarters ago in a company called Unsplash, and they really reach out into the long tail contributor and creator economy. And so we're excited about that acquisition and what it can bring to Getty Images. And then, there's Web 3.0 is taking shape, and I think we're watching how our content and our capabilities have relevance there. But it all starts with great content and really, customers needing more and more of it every day.
Hey, Craig, it's Julie here. I know you've been with the company since 2007. You've been leading it as CEO since 2019, if I'm not mistaken. How are you? And this is an interesting trajectory for Getty because it was a public company, then was a private company, now is a public company again. So how are you thinking about that journey now? And as a public company, what that will afford you, and what kind of resources you're going to be able to tap into as you look to that growth?
Yeah, well, I think, one of the constants of this business throughout is it's an incredibly profitable company. And that's what allowed us to go private and take on certain levels of leverage. But, what this transaction, going back to the public markets, is about is taking about $1 billion of fixed commitments off of our balance sheet through preferred stock and debt. And that gives us a lot of flexibility and a lot of firepower to really go after the market opportunity that we see in front of us. And we're excited about that market opportunity as I was talking through all those growth vectors, whether that's video or international, or just kind of reaching more and more customers. So we're excited for what this transaction means to our balance sheet and fundamentally what it means to our ability to pursue those growth trajectory. And we're excited for our employees. This is one where our employees, again, we can kind of give them equity in this business and allow them to really participate on a broad basis in the success of this business.
All right. Well, it looked like a picture-perfect video up there on the podium at the New York Stock Exchange earlier today, ringing the opening bell. Thanks for joining us here this morning on Yahoo Finance. Getty Images CEO Craig Peters. We'll check back in later on. Everyone, coming up on the other side of this short break, clip in Peloton hiking prices and scaling back on its retail locations as it looks to cut costs. We've got the deets for you coming up next. Welcome back, everyone. It is time for Cut for Time. 2 stories, 1 minute each. Today, we start with this. WeWork founder Adam Neumann has a new venture and a surprising new backer. Neumann reportedly starting a new company called Flow, which is focused on the residential real estate market and has the financial support of Andreessen Horowitz. Of course, an early investor in companies from Facebook to Airbnb. Okay, let's chat about this here. More funding for Adam Neumann after WeWork is now valued at...
I'm kicking this one to Julie.
WeWork is now valued about $4 billion. $47 billion was the peak valuation of WeWork. He walked away with hundreds of millions of dollars. This new company, Flow, and this is all according to the New York Times, by the way, this new company, through Neumann, he's basically bought 3,000 residential apartment units. I believe it's multifamily, it's apartments. And it's going to be, I mean, this is effectively a new version of what he had envisioned as part of the WeCo, right?
Yes.
That this is going to be all branded the same as Flow. And
Are we supposed to flow into these places? I mean, this is just, it's ridiculous.
I mean, it's amazing that after the story that and this is the largest single investment that Andreessen Horowitz has ever done in this round.
We wish them well. All right, the future is looking gloomy for Peloton after the company announced a $500 price hike to its bike and an $800 jump in its tread price after it had to cut prices back in April. The company also announced close to 800 job cuts. And guys, we saw Peloton shares. This broke late on Friday. Peloton shares popped on Friday, close to 20%, giving back some of those gains today. And, you know, I obtained a letter from CEO Barry McCarthy, who took over, I believe it's late in February, noting this. He said, quote, "Cash is oxygen. Oxygen is life. We must become self-sustaining on a cash flow basis."
That makes sense.
It makes a lot of sense. And look, Barry was brought in with a very specific mission to cut costs, get profitability correct. And he won't say this, but this is where this is going. At some point, Peloton will be sold within 3 years. That's what he is setting the stage to do, because I see these cuts as a clear sign demand has not come back. We've talked to Jim Chains last week, Planet Fitness Exponential, good results. Here you have Peloton cutting jobs. So, you know, the at-home fitness market, that bubble has popped and Peloton's struggling.
Well, sales are also your water as well in that life expectancy and moving forward. Well, got buzzed, but anyway.
I like all these analogies, guys. All right, we got to leave it there. Let's take one final look at the markets here as we see selling across the board here, although it's not quite as acute as we saw earlier in the session and what was indicated in the futures, with the S&P only off about 1/3% right now. Coming up in the next hour, Brian Chung and Akiko Fujita are going to speak to the U.S. CEO of eToro about the state of the retail trader. Obviously, it has been very interesting, fertile ground over the past few weeks in that space. You don't want to miss that.
Welcome to Yahoo Finance Live. I'm Akiko Fujita.
And I'm Brian Chung. Happy Monday morning to everyone. Let's take a look at where we are in the trading session. 90 minutes in, we can see red across the board with the Dow Jones down about 0.2%, the S&P 500 down 0.3%, and the Nasdaq down the same as well. If we take a look at the fixed income market, some movement happening in bond yields as well. When you take a look at the U.S. 10-year down, get this, about 7 basis points just this morning, extending those slides from earlier in June to 2.78%. Of course, a lot of other news headlines weighing on markets right now, but across the board, pretty much red across the board.
Yeah, one of the key things we're watching this morning, oil sliding as the energy space feels the weight of the weak economic data coming out of China. This raising concerns that a slowing global economy will reduce demand further for energy products. Specifically, we got economic data out of China this morning that points to this broad-based slowdown. We're talking about data on factory output, investment, consumer spending, real estate. All of that, of course, led the central bank, the PBOC, to cut two key interest rates at a time when we've seen, other major central banks going up. I guess you could argue that this is all, maybe not all, but a lot of this stems from the zero COVID policy. And it is these stop and go policies that just haven't allowed China to get the momentum going towards recovery.
Yeah, certainly. And obviously the economic activity, which covered the first quarter of this year, which China has substantially reopened since that point in time, pointed to just how damaging that was to the world's second largest economy. But at the same time, a lot of the factors that we're looking at in China are still kind of secular trends that were happening before the pandemic as well. When you talk about the government's essentially efforts to deleverage this very, very highly indebted economy, especially in the property sector, right? And the weakness in that area is one big reason why you have a lot of people concerned about the Chinese market. Bank lending is down as part of all of this, and then now that the PBOC is cutting interest rates, you do wonder about whether or not there is this concern that China is also going to get into some sort of hard landing or hard recession, which could have massive spillover effects globally.
Well, and it is to spur lending, obviously, when we're seeing what's happening over in China. You mentioned some other stats here, but it's worth noting youth unemployment. And that's something that we've talked about before in China. 20% in July. That is the highest number that we have seen since they began publishing that data. Granted, that's back in 2018, but certainly a lot of factors that are lining up for all of this. Obviously, we've seen some big moves in oil today on the back of it, coming off of the lows that we saw earlier on in the session, but still down more than 3%. Now, I will throw in one other thing that we're going to be watching throughout the day here, and that is any kind of decision on the Iran nuclear deal. Today is the deadline that the EU set for Tehran to essentially come to the table on this framework that they have created. Specifically, there's a key sticking point here worth noting right now. It's the IAEA's investigation into this material that was found in Iran back in 2019. Iran has said this is not a sign that they have a nuclear weapons program going. The West has disagreed. They have said, they as in Tehran have said that the condition to moving forward to revive this deal would be for that IAEA investigation to end. So the foreign minister's come out and said he will make a decision by midnight tonight. So we've got a few more hours to go, but that could be something to be watching in the context of the oil markets, too.
Right, yeah. So we'll see if maybe there are developments over the next few hours, but a lot of eyes, I'm sure, on any announcements that can come on that front. But shifting gears as well, a lot of other economic data crossing this morning domestically, where we saw, at least from the New York Fed, manufacturing activity seeing a sharp decline. The New York Fed reporting this morning down 42% on their Empire State Manufacturing Survey. You can see the line ahead of you. That's down to the lowest level since the pandemic time, and this shows just how pessimistic manufacturers, at least in the northeastern part of the country, are feeling. And combine this also with the information that we got from the National Association of Home Builders, the NAHB, where they said that they saw builder confidence fall for the 8th straight month. Quote, tighter monetary policy from the Fed and persistently elevated construction costs have brought on a housing recession. So if you kind of combine these two threads together, Akiko, what that really kind of shows is an American economy that does indeed have signs of slowing down, which the Fed might want to see because hopefully that cools inflation. But of course, the natural question is, has this started the momentum into a hard landing here with economic activity possibly falling off a cliff at the same time rates are still going up?
And of course, we've been watching the housing market really closely as potentially kind of the leading indicator of where things are going in the economy. Let's fold all of this into one big conversation with our first guest for the hour. We've got Steve Sosnick, Interactive Brokers Chief Strategist. Steve, let's kick things off. It's on a Monday, right, with where the markets are. I mean, we're coming off of 4 straight weeks of gains. Obviously, China's data today coming out weighing on investors as we see red arrows across the board. Where do you think we are in the cycle?
Good morning, Akiko. I think we're sort of in a part of the cycle where we have to be very careful about the hard landing. You guys just spent the last few minutes going over a series of indicators or a series of related stories that don't paint a good picture for the economy, and certainly will not be helped if the Fed continues to be on a path about fighting inflation, which I'm not suggesting that they don't need to be on that path, but it becomes inevitable. One of the problems specifically with China that, today I think it's being taken almost as a positive by the markets because, if Chinese demand is slowing down so dramatically, well, of course, that's going to impact commodity prices negatively. There's a lot of people who have, algorithms, whichever, programmed to say, okay, oil down, stocks up. So as a result, we're really not seeing any real give back. We've given back the levels more or less of the last few minutes of Friday trading, which in itself was a bit of a ramp. So, I think we're in a fairly precarious time for the markets, and a lot of investors sort of seem to be covering their ears and just doing what they'd been doing before.
So, Steve, that implies, though, that despite all of that, you still see a lot of retail activity. I guess I'm wondering on your platforms, despite Fed concerns, despite uncertainty out of China, despite a perhaps head fake on this bear market rally, people are still diving into stocks. Is that what you're seeing?
Absolutely. We are seeing it's not the meme stocks are the perfect tell for this, and to a certain extent, crypto coming back, testing 25,000 is another tell. The retail is back. We one of the most actively traded stocks on our platform, was MEGL, which went from like 7 to 250 and back down to single digits within the course of about a week. You have the HKD looniness, going from an IPO to over 2,500 and then large, giving back about 90% of it. So yes, what I'm seeing overall, and I keep finding the fact that I'm using this phrase over and over again, a lot of people are using the playbook, the 2020, 2021 playbook over again. It was a spectacular playbook for that period of time, but the rules of the game seem to be changing, and people, for now, the playbook is working, but people seem to be using the same playbook and expecting the same results. In the short term, I think it's been fabulous. I think it was a great bounce off an oversold condition, but I have to wonder if using the same investment playbook that worked for you, which includes don't fight the Fed, which in that period of time was, the Fed was your friend. Now the Fed is kind of a headwind. This is the problem I start to see.
I mean, what is the key difference? If you've got retail investors out there who are saying, well, why not go with the same playbook, given the gains that we saw on the back of the big declines we saw early on in the pandemic? And what's the key difference in, should they be buying the dip?
Well, buying the dip is a great strategy. On the other hand, we're up well off. We're not at a dip anymore. We're well off our lows. Looking at the backdrop, I'm not going to criticize investors for having bought the dip. It was the right strategy at the right time. We were very oversold. We went into earnings with the most dire expectations, and earnings were better than feared, certainly, and that provided a lift. And I think the last part of this rally has been the investors sort of taking Powell's neutral comment to heart. Meanwhile, all the other Fed governors who've spoken since have basically been squashing down on that idea. But now you're in a momentum phase. And so investing just because of momentum, that becomes a bit trickier than trying to time the dip. The meme strategy worked great for whoever, memes. The meme stock trading works great if you're early. It works terrible if you're late. We've seen that time and again. Those seem to have a shorter and shorter half-life in terms of success rates. And in terms of other stuff, there are plenty of good stocks to be buying out there. I don't want to really squash down on this, but just sort of, when I saw Friday, the strategy of sort of, instead of don't short a dull tape, it became let's buy at money expiring SPY calls. And then as it moved up a little bit, let's roll them up to the next strike and then the next strike and the next strike. That was just pure momentum on nothing. And so that becomes a much more tricky environment to try to base your trading from the long side on.
So, Steve, I mean, you talk about HKD, you talk about a number of other names that were popping lately. I mean, a lot of people perhaps trying to draw comparisons to what happened in the beginning of 2021 with GameStop to some of the activity that we've seen over the last 2 weeks. Are you seeing any sort of similarities? And is there a reason for a macro backdrop contributing to that, or is it completely unrelated?
I think the macro backdrop was much more prevalent in early 2020. Early 2021, because you had massive Fed liquidity injections and stimulus checks. People, a lot of investors literally got money deposited into their accounts. Now I think it's sort of more of just, we can get things moving in a short period of time. That aspect of it hasn't changed. That's why I alluded to the idea of people using the same playbook. But each of these moves, HKD of course being the exception, but for the most part, GameStop, Bed Bath & Beyond, et cetera, my theory then and now is there was always a certain amount of investor nostalgia to them. People just didn't want to see their old favorite mall stores getting picked on, and so they went after the shorts. Also to be said, shorts, people have been going after the shorts for as long as there have been shorts. So that's also not a change in strategy. The popularity of it certainly is greater. But in each of these situations, there's less organic nature to it. In the initial meme stock craze, you got people coming in who'd never invested before, putting money into these stocks and investing. Now it seems to be the same cast of characters chasing the same list of names with a couple of new exceptions every so often. That becomes more of a self-contained loop, and it really becomes much more about, it's always been about timing, but now it's really strictly about being early.
Steve, really quickly, moving away from meme stocks, what do you like right now? Where are you putting your money?
Right now, quite frankly, as a volatility person, I'm starting to look more in terms of volatility plays and getting a bit defensive. The VIX flirting with 20 means that there are more opportunities to be hedging some of your gains. I actually start to think about looking for pullbacks, being a contrarian. I think starting to look at energy is probably not a bad place to go unless we really feel that the wheels are going to come off in China, because it is going to be winter at some point in Europe, and I see another round of stress coming. But those would be the two biggest places of focus for me.
Okay, as always, some good takeaways there. Steve Sosnick, Interactive Brokers Chief Strategist. Appreciate your time today. Well, let's take a look at shares of Poshmark. Seeing a big rally in this session here, up about 12.5% on an upgrade from Barclays analysts, upgrading the stock from equal weight to overweight. They also raised its price target to $17 a share, citing secular tailwinds in the secondhand clothing market. Barclays saying that consumers are likely to trade down in a softer macro environment, adding that social and gamification aspects of the platform specifically give Poshmark an added lift in engagement. This comes, of course, as Poshmark posted a wider than expected loss in its most recent quarter. Well, coming up, is crypto the new gateway for amateur stock traders? Our next guest breaks that down and why the bear market may have instilled caution in a new generation of retail investors. We'll be right back.
World of crypto on this Monday morning and see if there's any interesting price action. You could see Bitcoin down about 1.6%, but actually watch what happened overnight. We actually saw Bitcoin break the 25,000 level for the first time since mid-June, which shows that there has actually been a pretty nice bounce back in Bitcoin, commensurate with what we've seen in the stock market, although, of course, on a year-to-date basis, still very, very far from that above 45,000 level we had earlier in the spring. If we take a look at some other cryptocurrencies as well on the move, Ethereum down 4% to 1,900, and also watching Doge, why not, down 4.2% to about 7 cents a Kiko.
Okay, well, with the markets experiencing a tremendous amount of volatility of late, investors on trading app eToro aren't shying away. According to a Q2 retail investor survey from July, 92% of investors either held on to investments or bought the recent dips. But how's that continued to hold up over the past few weeks? For more on this, let's welcome in Lule Demise, eToro US CEO. Good to have you on today. Let's start with that question. Brian was talking about crypto specifically, but broadly speaking, what kind of inflows have you seen on your platform in recent weeks?
Yeah, I mean, broadly speaking, for us, what we see is consumers who are cautious but optimistic in the way that they behave. So most of our customers are customers that have told us and have through their behavior that they are more buy and hold, and they are holding through the dips here. There's definitely a split in between our customers when it comes to, about half think that the markets are going to return soon and half think that this is going to be choppy for some time. So the cautiousness is still there. But what's really interesting, I think, from what we've seen on our platform at eToro USA versus, let's say, I've been in this industry for many years, and what we saw in 08 is that people are more cautious, but it doesn't look like they're panicking.
Lule, it's Brian Chung here. Great to have you on the program. So, is there any sort of change, though, in the allocation? Because we have noticed over the last, let's call it 2 months or so, a pretty remarkable bounce back across a number of different asset classes. Do you find that people are going into, for example, meme stocks or crypto being more risk tolerant than they were, say, at the beginning of the summer?
Yeah, it's interesting. Our platform is in some ways an anomaly because we attract tomorrow's investors today. So over 55% of our customer base is older millennial-ish, right? And the majority of our customer base is actually Xers and millennials. So we actually see a different spectrum, if you will, of the investor base than most other places. And so for that reason, because these people have a longer arc in their investment life cycle, they can afford to remain sort of long-term and less panicked about the short term. So we do see still people who are less averse to risk. Again, not necessarily new purchases, but what they're holding. And in addition, we're seeing in some instances, especially among our Xer consumers, a little bit more flight to quality to be able to endure this choppy market. But again, not a flight to quality that's wholesale, but at the margin.
Yeah, I mean, how do you think that has shifted from where we were, let's say, at the beginning of 2021? We've talked so much about the growth of the retail investor, but also the evolution. In January of 2021, it was about the meme stocks, and we're hearing increasingly that they're getting into ETFs. They're getting, to your point, into more value plays. How has that broad portfolio shifted as you see it?
So a few places. So one is, you see, as I said, a little bit more at the margin flight to quality, not a panicked one, but just a smart one, right? Because you're seeing more flight to quality right now. We do see consumption in more, if you will, pickier consumption in terms of either the sectors they're picking or the asset classes they're picking. But again, because we have longer term investors, there's a lot that are also seeing this as a buying opportunity. So we do see uptick in technology and other places in which, even though the market has given up some of those gains in the past few months, individuals seeing that as a buying opportunity because, again, their horizon is longer. When you're looking at our platform, you're saying millennials and Xers, majority millennial. It's a different mindset, if you will. The one thing I will say again is millennials of today were not the millennials of 08, meaning, again, there is that wisdom of the crowd that I feel is you see it embedded in the behavior of the investor that I feel like was not there in 08. Caution is definitely here, though. We can't underestimate that people are cautious. I think the underlying thesis here, though, is that it's not panic.
Well, can I ask if that millennial dynamic plays into an interesting stat that I read here, which is that younger investors were actually least likely to hold, but more likely to buy more with prices down. So net, is that actually more willing to take on risk? Because that's a bit surprising to me. I thought that it was the younger people who might be more hodl, let's diamond hands here.
Yeah.
What's going on there?
Yeah, I mean, I think part of it is, the story that feels sizzly and exciting is the meme stock, right? And it makes sense, right? And most things that we read, it's interesting, but actually that's not where most of the consumption behavior is, right? A lot of the consumption behavior is not as undiversified as we think it is. People can still partake in a particular individual security that's high volatility or, again, very depressed right now in this market environment, but still buy a diversified ETF instrument. Like they're not necessarily divorced from one another in the consumption behavior of many individual investors that are on our platform and in retail at large. And so I think part of it is like not to get lost with the flash headline and to make sure we're looking at the behavior of the broader body politic of investors that have come into this market.
Lula Demese, eToro US CEO, it's good to have you on today. Appreciate you stopping by. Well, coming up, it has been 1 year since the U.S. withdrawal from Afghanistan. How's the president's approval rating fared since then? Spoiler alert, it's not good. We're going to be tracking that on the other side after we come back. President Biden's approval rating hitting the highest level since early June last week. That's according to a Reuters Ipsos poll. His numbers began to slide in the aftermath of 2021's hasty withdrawal from Afghanistan. That was 1 year ago today. Let's bring in Yahoo Finance's Rick Newman, who's been tracking all of this. And Rick, I was just looking at the numbers here. President Biden's approval rating hasn't been above 50% since August of last year. He's got a few wins to go off of, but how does this anniversary and then the reminder of that sort of coincide with the more recent legislative victories?
Yeah, last summer was a lousy summer for Biden, without a doubt. In addition to the ugly withdrawal from Afghanistan and then the prompt takeover of Afghanistan by the Taliban, we had other things going on that were working against Biden. First, don't forget about COVID. Biden had said earlier in 2021 that he was anticipating a summer of freedom for Americans, but it wasn't that free. We had new variants, and we were not as free of COVID as Biden led people to think. And we were also starting to get signs of inflation, including rising gas prices a year ago. So as you point out, Biden's approval rating 1 year ago was 50%. That is a pretty good rating for presidents. It's now 40%, basically 10 points lower. And that is an improvement from where it was just a few weeks ago. But Biden is far from where he was last summer, and that means there's a lot of ground to make up. And of course, the effective deadline here is the November midterm elections, which are now less than 3 months away.
Rick, I want to shift gears from Biden to Trump. Obviously, the Mar-a-Lago raid still catching a lot of attention. Has the former president said anything? What are you hearing the latest on that front?
Trump has said something. He has said, he said in a Fox News interview this morning, the temperature in this country needs to come down. And he's referring to threats against the FBI. There was one apparent attack at an FBI office, threats of civil war. Steve Bannon is saying we're going to take down the FBI. So Trump said we need to take the temperature down. And I think that's very interesting in the context of what we saw recently with the January 6 commissions, which got into what did Trump do during the January 6 riots at the U.S. Capitol? And the answer was nothing. He did nothing for many hours on that day. And now we're seeing Trump coming out, you could argue, in a different way than he did on January 6th, saying, everybody cool it, perhaps trying to assure there are no further incidents related to this raid and the seizure of those documents. But this is going to go on, this issue, because we don't know what's in the documents. It's possible we could get the release of more information, giving us more detail about what the FBI and the Justice Department were actually interested in. And with regard to all the classified documents that were there, so we don't know what they were. And we also don't know if Trump shared them with anybody. And that is a really important question at this point. Did these just sit there in the basement of Mar-a-Lago, nobody looking at them, or did Trump actually share them with people who did not have the authority to see those? So this case is going to go on, and I don't think we're going to know the full details before the midterm elections.
Yahoo Finance's Rick Newman, thanks so much. Well, let's continue that conversation about the legal problems down in Mar-a-Lago. Yahoo Finance's Alexis Keenan joins us on set for that conversation. Obviously, a lot of eyes on the affidavit, right? What needs to happen for that to be released? And I imagine the classified versus declassified significance is going to be very important for that.
So really, it's the focus on this affidavit, right? So the part that has been released so far, or parts, I should say, is one, the search warrant itself, and also the list of items that were seized. So the affidavit, though, that's a different beast, because that is the narrative of why exactly law enforcement and the DOJ is making its case. It's the DOJ's case to the judge to say why the judge should issue this warrant to go into Mar-a-Lago. So that is where the really breadth of their case, at least at this stage, will be detailed. So that would tell us a lot more about why they wanted those and whether or not their case is very strong against Donald Trump. Though exceptions can be made, we don't know, right? We don't know if the DOJ wants to release this affidavit. We don't know if President Trump would agree if the DOJ went to him and said, do you object? The last time President Trump said, no, I don't object to these documents being released. That could be different on this different round. Either way, a judge, again, would have to be the one to make that determination. Cases where there is a great public interest, those can be exceptions where the documents are released and the judge will say, okay. And also the Justice Department or any other law enforcement agency, for that matter, could say that they want to substantiate their reasoning, because in this case you have President Trump and others attacking the justification for this search warrant. And so in order to combat that and say we do have some evidence for and reasoning for going into Mar-a-Lago, that could be a reason as well.
Well, I was going to say the context of that is important, because we have seen the narrative shift on the Republican side. This weekend, a lot of lawmakers came out and said, look, we just want that affidavit unsealed so we know for sure what the justification was going into Mar-a-Lago. This isn't the only legal problem for the former president. Right. We're talking about another case with the Trump organization that you're following.
Right. So on Friday, the Trump Organization and its long-term CFO, Alan Weisselberg, the two of those parties are defending a case against the Manhattan DA. And that is a case involving whether or not there was knowledge by the organization or by Weisselberg that there were different valuations given to real estate depending on whether it was for tax purposes, tax filings, versus applications for mortgages, right? So in the case of mortgages, you want those valuations to be high. In the case of taxes, many times you want them to have low valuations so that they're not required to have a big tax burden. But in this case, on Friday, the two defendants, they lost their motion to dismiss the case. And so that means the case will be able to go forward. A trial date is already set of October 24th, and that's a pretty rapid pace for the DA's office. So this case is going to, if that trial date sticks, it's going to come to fruition really quickly here. And that will then impact likely a civil case. So this case that I'm talking about, that's a criminal tax fraud case. Then on top of that is a little bit of a mirror case by the New York State AG's office. And that one is making similar claims, but they're civil claims. So they don't have prison time that could be attached to them. But many things about that first case will impact the second. So a lot still to happen in those business cases for President Trump.
It's so hard to keep track of all of them, but that's why we have you.
I'm trying.
Yahoo Finance's Lexus Keenan. Thanks so much. Appreciate it. Still to come, too many cooks in the kitchen? The streaming wars heat up as new players look to enter the space. Our next guest says it might be a little too pricey for some. On the other side. The streaming war is heating up as big box retailer Walmart looks to bundle a streaming service into its Walmart Plus membership. That would fire up competition with Amazon for good reason, because the New York Times reporting that Walmart held discussions with executives from Paramount, Disney, and Comcast in its search for a streaming suitor. Joining us now to weigh in is Maribel Lopez, founder and principal of Lopez Research. Great to have you on the program this morning. You've pointed out that motivation is really the key thing to assess here, because a lot of people might be wondering, why is Walmart trying to get into the game? What do you think is the strategy here?
Absolutely. They're looking at, we have a subscription service. Amazon has a subscription service. How do we compete in the retailer wars going forward? We all know that content is what creates stickiness in today's world, and Walmart is lacking that today.
So it is about creating stickiness, but you point out in your notes that this is not about Walmart getting into the content business. I mean, that would be kind of a new proposition, right? Amazon's platform is sticky, but they also put out original content. So what's the proposition for Walmart? How do they compete if they're not going to churn out their originals?
I think if Walmart wants to maintain its margins and have a content service, it really needs to think very seriously about being a channel for other content providers. You can't go into original content and not spend an enormous amount of capital. So given that, the safer play would be to try to go to market with other people and make that offering you have on the subscription side more compelling. They already have something going with Spotify. So the question is, they don't really have any video content. Also, this is not Walmart's first rodeo in terms of looking at content. So this time they need to get it right.
So I guess original content question aside, I thought that the whole point of streaming services was to get away from bundles that you had to get from a cable provider. So if Walmart is going to be packaging together stuff from Paramount or Disney or what have you, isn't this just bundling again?
But it's not really a bundle, I think. Well, first of all, we don't know exactly what their play is, but a smart play would be to do it a bit more like the way YouTube is thinking about it and say, hey, there are these 3, 4, or 5 services that you can actually have access to, perhaps at a discounted price, but we are the channel to help you get there. So it's basically an offering. And frankly, most consumers are very fickle and dropping off their streaming services quite routinely and moving amongst them. So having this kind of channel play might not be a bad case for Walmart, might actually help push them forward.
Let's talk about another story out of the Wall Street Journal, specifically citing YouTube looking into offering these third-party channels on their network, sort of similar to a Roku. I mean, how big of a threat does that pose to Roku, and how do you think YouTube's positioned to do that?
Well, I think Roku has many threats, and this is just the latest. However, you can't count YouTube out as having a presence and a channel and the ability to attract an audience. And this is really one of the things I think that's going to fundamentally hurt Roku's progress moving forward.
Maribel, I want to just kind of ask a big picture question in the streaming world. We've seen some of the headlines coming out of HBO. We've seen the headlines coming out of Netflix. Concerns that maybe the overspending on content has to be pulled back a little bit, especially with these recessionary fears. How much do you think that's going to impact the future of streaming services when you consider that there could be other emerging competitors, like, for example, Walmart, that could snatch up some market share?
I think this is survival of the fittest right now, but really, if you are serious in the content game, if you're someone like a Disney or a Netflix or an Amazon or an Apple, you are going to continue to build original content. The issue is, are you going to continue to have some of these big box stars actually in this content, or are you going to go with the concept of a deeper, broader catalog? And we're actually starting to see Netflix really dig into both sides of this right now, trying to broaden the content geographically, broaden the different audiences that they're looking to serve, and create some original content around that. So I think basically breadth and depth, but perhaps pulling back a little bit on the big brand name actors might actually allow some of these companies to continue that original content play.
All right, worth watching, especially as Walmart earnings coming up later this week. Maribel Lopez, founder and principal analyst of Lopez Research, thank you so much for stopping by. Well, time now for a quick detour before we head out to break, and want to highlight a very alarming emerging bubble. Well, it's boba tea, rather. The drinks with the tapioca pearls were a $1.9 billion industry in 2020. And if you thought there wasn't room for any more boba tea shops in your neighborhood, tech company Bobachino highlighting that the industry is expected to more than double to a $4.3 billion industry by 2028. I was so excited I got tongue-tied there.
Okay, so can we just do a brief history of boba? Because
yes, let's.
This has been around since the 1980s, originated in Taiwan, and here we are in the West talking about this doubling beyond where it is today, right? A little research on my end.
Oh, man.
Yeah, I mean, you've probably seen around New York City so many boba shops. The city with the largest concentration in America is Garden Grove, California, and here's an interesting stat. This is a city of over 170,000 people. As of July 2020, 33 boba shops so one store per 5,200 residents.
One store.
Yes. Okay. But here's the context. And I promise I'll shut up after this. Compare that to Starbucks. In Starbucks in America, there's one store for every 21,000 Americans. Yeah. So, I mean, that concentration of boba shops is way more than Starbucks in certain cities.
And you and I are guilty of this as well. I think it's because there really is a difference between boba tea shops. And people will fight for what they say is the best boba tea shop. I mean, we have graded New York area boba tea shops before.
This is a constant conversation.
An interesting stat that I would like to see is how many has anyone ever counted the amount of tapioca pearls that those 33 boba tea shops would represent? Like, how many?
Can we talk about inflation in boba too? $8 a drink now?
It's hard to get out of a boba tea shop like under $8 or $9 anymore these days. And by the way, we were gonna have boba tea on set, but apparently no boba tea shops open before noon on the East Coast.
They might have a lesson to learn from Starbucks.
Unbelievable.
Yeah, gotta open earlier than that. All right, on the other side, the UK gives the green light for the very first variant-adapted COVID shot. We're gonna have the details right after this break. We are tracking the continued fight against COVID-19 with the UK, the first to approve a vaccine that targets both the original and Omicron variants of COVID-19. Let's bring in Yahoo Finance's Angelique Kamlani for the very latest on that. Let's start specifically with the monkeypox issue because that has been, a big concern.
That is. And so what's going on with the monkeypox issue is that we've seen a struggle for the U.S. government to get to those doses in arms into the places of distribution, largely because these doses are coming from the national stockpile. The strategic stockpile has not been set up in a way to allow for ease of distribution. It was really set up as a way to sort of mass distribute doses in the case of a catastrophic event. A new New York Times report detailing the reasons why it has been so tough for high-risk patients to get access to these doses, in large part because of a lack of, tracking systems, et cetera. The CDC does have a system set up, and that's where vaccines largely do come from. And we know, especially during COVID, special situations were set up, special networks were set up with private contractors in order to make sure that those doses get to where they need to safely and correctly. So that is what the health department is looking to try and implement with a new system that has been rolled out, but it might be a little too late.
Anj, on the subject of COVID, the United Kingdom apparently being the first to approve a vaccine that targets both the original and the Omicron variants. Tell us more about that.
Yeah, so Moderna is the first one to get that out the door with the green light in the UK. They had been working on not just Omicron, but they're also working separately on a BA.5 targeting one for the US. We're hoping to hear more on that later in the year. But as of right now, the UK the first and the EU to follow soon after that, possibly next month, with this focus. They decided to go the route of Omicron, and we heard from these companies, including Pfizer, earlier this year that they were already working on an Omicron bivalent vaccine, ready to roll that out earlier, but because the U.S. decided to shift, they're now having to pivot and do two separate trials and focus on two separate variants. So that's where things stand right now.
And before we let you go, can we talk about this?
Yes, we can. This is a salvar. I am just celebrating India's 75th independence. It is the world's largest democracy, so why not give it a shout out?
I love this. This is beautiful.
Thank you.
Great outfit. Thanks so much for that, Anjali.
Well, time now for our chart of the day, and it's just a flashback to a company that we talked a lot about in the before times, and that is, of course, WeWork. And we know the story, right? SoftBank came in with the big money, excitement over the IPO ensued, and then floundered as people found out the business model was maybe a bit flimsier than investors had hoped for. But now the company living a new life, albeit a very small one, after going public by a SPAC. And the reason why we bring this up is because now Adam Neumann, apparently back with the support of venture capital giant Andreessen Horowitz, Akiko, $350 million coming into a new project called Flow, which the details still a bit sparse on this. The New York Times reporting it could be a living, kind of co-living situation like a We Live in the before times. But again, Adam Neumann getting money again. So,
look, I guess there's always a second chance, although this is probably Adam Neumann's, fourth chance, fifth chance. By the way, he also has a company that fights climate change through cryptocurrencies. Yeah. That didn't go too well, given where crypto has moved.
Well,
I mean, look, we've talked about this a lot. There's a lot of money to be deployed.
Although in this time, not everyone has the money to do it. In fact, Andreessen Horowitz might be one of the few venture capital firms to be in a position to do this. But again, just the name of it. And A16Z, by the way, had a blog post where they were essentially talking about how much they value Adam Neumann as a visionary. They think that the commercial real estate sector is going to be very different with this work from home situation. But we know what happened last time.
It feels like we've heard this conversation before of Adam Neumann being a visionary. But hey, I mean, we'll watch, right?
Yeah.
Who are we to judge on initial? I'm sure there's a lot of WeWork employees that.
I'm sure we're watching this very closely. Yeah. Well, we will have to see. You get it? Forget it. On the other side, activist investors making moves in the House of the Mouse, Walt Disney World. And of course, the third point is going to be pushing Disney to move in on Comcast. That's the latest. We'll have the coverage on the other side. shares of Disney on the move this Monday morning after Dan Loeb's third point repurchased a significant stake in the company. You can see shares up about 3% so far. Loeb pushing the media giant to spin off ESPN, saying the sports network would have greater flexibility to pursue other business initiatives separate from Disney. Let's bring in Yahoo Finance's Alexandra Canal, who's got the details. What is Dan pushing for here?
Yeah, Brian, and what's interesting here too is that Dan Loeb previously held a stake in the company from 2020 to early 2022, selling that stake off in March. So the fact that he has now repurchased a, quote, significant stake in the company following that strong Q3 earnings report signals that he's bullish on the direction. He did cite the strength of the streaming business, but now he wants to be an activist investor. And as you mentioned, he's laid out some pretty significant changes to, quote, unlock further value in the near term. One of those suggestions being the spinoff of the ESPN network. He said the network would have greater flexibility to pursue business initiatives that they may be difficult to pursue being a part of Disney, such as sports betting. Now, interesting thing here is that on the earnings call, CEO Bob Chapek said that the company is still pretty bullish on sports and that they were working hard to announce something on sports betting. But investors and analysts have long questioned the future of ESPN, the future of ESPN Plus. Where do things go from here? So I don't think this is a new idea. I think this has been internally debated at Disney. Also something that the street has been closely watching. Another suggestion from Loeb being that buyout of Comcast. Comcast owns a 33% stake in Hulu, and Loeb really pushing for Disney to buy them out sooner rather than later, ideally before that early 2024 contractual deadline. He even said, look, if you have to pay a premium to get out of this, that's important, and that needs to be done really, really soon. Other changes include more cost-cutting plans, refreshing the board members, continuing that suspension of its cash dividend payments. So we'll see what comes out of this. The stock is up around 3%, so it's a bit of a confidence boost, I think, heading into the second half of the year. But I think it is clear that Disney still has a lot of work to do, despite those strong earnings that we saw last week.
Well, Ali, specifically on ESPN, I mean, I realize what Dan Loeb is saying, but also, you know, we're talking about additional revenue channels that are needed. At least that's his argument at a time when we have seen ESPN face a lot of competition. Sure, it's still the leader in sports, but we've talked a lot about other streaming services getting in on the sports space, whether that is Amazon or Apple too. I mean, how much of this plays into that too? And really this idea that we've heard a lot of analysts talk about before, which is migrating a lot more of these games onto streaming specifically.
Yeah, I think that is a huge factor. We have seen Amazon, Apple really lean into sports content, sports betting, and ESPN, it struggled a little bit. They're potentially reportedly losing the rights to the Big Ten League. That is something that could go to one of the other media giants out there. So I think people are trying to figure out what's best for both businesses, right? What's best for Disney? What's best for ESPN? And if a spinoff is the answer, what are we waiting for? And I think investors really want to see a clear strategy for Disney. Clearly, the legacy business, advertising has slowed. That's not the future of the company. So what is? And I think this is a critical point for Bob Chapek. He just got that contract renewed. What are you going to do with ESPN? What are you going to do with all of your other properties? So I think really what everyone wants is him to have a very clear direction on where things go from here. And ESPN is certainly a big part of that equation. So we'll have to wait and see what happens there.
A huge part of that. Yahoo Finance's Alexandra Canal, thanks so much for the breakdown there. Well, let's get one final look at the markets before we say goodbye here in the 11 a.m. We can see actually a little bit of a ramp higher.
A reversal.
Not because of us, of course, but seemingly some action happening in that space. Dow Jones now up 0.3%. The S&P 500 up 0.2%. And the Nasdaq up 0.4% as well. You wonder if maybe this has to do something with oil prices as well. We were talking about that with Steve Sosnick earlier. Maybe oil prices, as we've seen some action here, right, going down. WTI crude oil below $90 a barrel. Maybe that's part of that story.
Yeah, and if we think about where the pullback was early on, it was on the back of overnight data that came through. So certainly investors kind of processing that along with everything else. But that does it for Brian and I in these hours. I'm going to let you say it.
We'll see you same time, same place tomorrow. Have a good one.